If you truly want to master trading and make life-changing amounts of money, there is one thing that you need to do, and that is understand why price moves the way it does. You see, price is a language. It's a completely new language. It's a foreign language. And the only way that you will be able to master it is if you can learn to read it. And so that's exactly what I want to share with you. Look, I've been trading now for over 6 years. I've made over 7 figures directly from trading. And that is all because I learned how to read the language that the market was telling me. So now every time I look at a chart, it literally speaks to me. I actually understand what is happening. And if you can truly understand what the market is telling you, then well, of course, your decision-making process is so much simpler. There's no more randomness, there's no more inconsistency. There is just action upon the information that you're receiving. And that's what I want this to be for you. And so again, this is a 5.5-hour masterclass breaking down every single trading concept that you truly need to understand the language. Each part of this course is purposefully designed to teach you part of the language that the market is telling you. By the end of this course, you will literally have every concept that you could possibly need to actually understand the price. I'm talking everything on market structure, liquidity, supply and demand, order blocks, fair value gaps, daily bias, and there are a couple more bonuses inside, small details and concepts that have truly helped me and transformed my trading. And on top of all of that, at the end of the video, I'm going to combine everything that you have learned into a detailed step-by-step trading strategy with a trading plan and live trading examples of this plan in action. And so please, this is by far the most valuable video that has ever been produced on this YouTube channel. So take it seriously. This is not for entertainment purposes. Get a notepad, get a pen, take notes, and please enjoy.
Market structure is by far the most powerful technical analysis concept that you can use if you want to become a profitable trader. And yet it's so easy to get it wrong. And honestly, that's why most traders fail. You see, as a trader, the most important thing that you need to understand is which direction is the market likely to trade. If you can get that right, you drastically minimize the chances of you losing trades and drastically maximize the chances of you winning trades. So diving straight in, there are 3 phases in which the market is always trading through. On the one hand, we have the bullish expansion. This is where price is progressively getting higher, making a series of highs, higher highs, lows, and higher lows. A higher high is simply when a high breaks an old high. That is your direct indication that price action is bullish. Price is more likely to trade higher in the future than it is to trade lower. Already you have a statistical edge. And again, the same thing is when these lows are getting higher than the previous lows, right? That is, again, signs of bullish price action. Now, eventually what happens in every trend is it gets exhausted. And the first sign of a reversal is usually a consolidation. A consolidation is where we have a high and a low that is in control of the price action, right? That is your current market structure range. Now, what price does is it usually spends a decent portion of time just kind of moving sideways below the high, but above the low. So not really giving us any clear direction. Is price going to continue trading higher? Is price going to trade lower? That sideways consolidation is usually the first sign of the next leg up, or in many cases, a bearish correction. Then usually we have what follows is bearish expansion. And the bearish expansion can be categorized by understanding when the bullish structure has shifted. It is not, which many people make the mistake of, when these lows in here start trading lower. It is when this low right here that is responsible for breaking the previous high and putting in this high right here gets broken and traded through. That is what we call a change of character. The shift from bullish to bearish, right? Think of the bull is in control and then the bear becomes in control. Those are the 2 characters. We change character, right? And then we begin with the bearish expansion. So we put in a lower low. This low right here is lower than the previous low, indicating bearish price action. Then we have a lower high. This high is lower than the previous high. And then we get the continuation, break of structure, lower low, lower high, and lower low. From here, what you're expecting then is very simple. And your only job as a trader is to understand that price is now bearish. Therefore, how can I look at shorting, right? And those are the things that we'll get into later in the video. But what you're essentially expecting is when price retraces back up to these highs, I want to find an opportunity to get involved in short positions. and then I can take the market down here. And so that is, in essence, the three phases of price action that we will continuously see play out. Now, if we come here to the actual live market, you'll see this unfold in real time. What you can see here on euro-dollar 30-minute time frame is that we have bullish price action. So we have a swing low down here. That price puts in a high up in here. This high puts in a low down here, right? Notice that this low is higher than the previous low. Then we have a break of structure with a higher high, right? So now we have highs getting higher, lows getting higher. Then you can see we have this pullback before a continuation. We continue trading in this bullish direction. Then we have a pullback. Again, what do you think is your job at this point in time? We have this low, we have this high. Our structural range is this high to this low. You're looking to long the market. And so when price starts coming its way back down here, the goal is to get involved in this bullish move and take out this old high. Once this happens, you have a new low, right? And then a new high. Now look what happens. We've had a very aggressively long bullish trend. And then eventually what happens is we put in a high right here, right? And we have our low down here. So that is our current structural range. Now what happens is price starts to move sideways, right? We don't really get a real break of a high, a real break of a low. In fact, what you see here is that we get this wick, right? And for me, a wick is not a break of structure. That is what we refer to as a liquidation. You see, every time that you have a low and every time you have a high, when price approaches this level and it wicks above that level, you can likely expect that price will then reject that area and trade in the opposite direction. And the reason for that is purely based off of the order flow. Price gets above this high, and then the thing is no one is willing to now buy more orders above this high. And so that's why we have the wick, right? And price closes back down here. And that essentially tells you with just that wick that price is not willing to trade higher. And because of that, you can already indicate weaker price action. So if I know that a wick is a sign of weakness as it expands out of a range, then why would I want to buy out of that range? It's going to likely go in the opposite direction. The same is true on the sell side, right? You can see we get the wick and then we have a reversal, right? If we then look at the low down here, ultimately what happens? We fail to break through this low. We wick the low. That to me is a sign of weakness, right? It's a sign of reversal. And then you can see we end up reversing and we come back up here. So we can see here, we're getting wicks of the high and wick of the low, which is really just indecisive price action. This is a consolidation phase. And the likelihood is, in many cases, when we get this type of consolidation, is that a reversal is most likely coming because price is unable to keep trading higher. The reality is if market structure is continuing to go bullish, there would be no problem trading through this high and continuing like we have done many times in the past. We trade above, we continue, we trade above, we continue. Here, we try to trade above and we get a rejection. That simply tells us that the likelihood is that we're gonna reverse. Again, if you look at this liquidity concept, you can see all the time when you have a higher or low that gets liquidated, right? Here we have a low. Look what happens. Price comes into that low, it wicks below that low and reverses. Price comes into the high, it wicks that high and then it reverses, even down to the minute micro details, right? We have a high here. Price comes up to this high, wicks up that high and then reverses. So always pay attention to when price is wicking a low or wicking a high and look at that as a sign of reversal. Only when we can close below this low down here can I then say, great, now we have shifted. We are no longer bullish, we are bearish, expecting lower prices. And we can see how that unfolds, right? We become bearish, price trades aggressively to the sell side until we find a low, we have a retracement, we find a high, we have a continuation, we find a low, we come back up, we find a high, and then we continue trading down here, low, high, and then this brings us to right now's current day price action. I would expect that today's most likely going to trade lower. It already gives me my indication. That is the importance of market structure, right? It's going to tell you the directional bias. But here's the catch. Now I've made that sound simple and look simple because in all honesty, it is. But there are a couple of things that are messing people up, and this is one of them. It's this idea that there is a real market structure, and it looks like this, and it confuses the crap out of people. What we have is a high, we have a low, which is what you've been taught, we have a higher high, amazing, very easy to understand, right? It's what you've been taught. But then it starts getting complicated because you start having pullbacks that look like this. And now what a lot of people do is they look at this and they're like, okay, we have a low, we have, okay, this high is lower than the previous high. Okay, we have a lower low down here, a lower high. Okay, we're obviously bearish. So let's sell the market. And so what do? They start selling the market down here, not realizing that they're looking at the wrong structural points. It's a critical mistake that traders are making when it comes to market structure, is they don't understand which structure, which highs, which lows to use. And that's what I'm going to break down to you now. You see, this is the low that breaks through the high. This is the high that begins the reversal. So that's all you need to have. You have your swing low and you have your swing high. We've broke structure, so we are bullish. Now, until price breaks below this low, we do not shift bearish. We only look for longs. The problem is many traders are thinking that price is bearish because of these lows, but they're reading the wrong market structure. They are reading internal structure. You need to be focused on these swing points in here. You can only get the green flag to go long and continue when you get, okay, we're bearish internal, great. Now we're bullish internal. Now it's the time to look for longs. And then you can see price breaks structure. So now we break structure here toward the buy side. Now here's the other kicker. This is now our swing low. This up here is our swing high. And so we're expecting longs. We're expecting that price will respect this low and it will target this high. Again, here's another fatal mistake that traders make, is they look at this and they're like, okay, we have a low. Okay, we have a higher high. Great. Bullish. Okay, higher low, higher high. Okay, so here's my low, here's my high. Oh, look, we break through this low. Okay, now I'm going to look for sells because we're bearish. Wrong. Until we break this low, it is the lowest point that structure comes before breaking structure again. It's this low right here. Many traders are getting trapped on the wrong side of the market. That's why there's so many failing traders, because they don't understand how to read market structure. You have to use this low and this high. So when this low gets taken out, that for me is like, great. That's an inducement, right? Because so many traders are now going to be looking to go the other side. But for me, I'm still very much bullish. And so when I get this shift above here, that's my green light. And then I patiently wait for price to come back in. And then where do you think that price is likely to go to next? The next logical target is for price to run toward this high. That is real market structure. It looks confusing, but it's very simple. It's not really much different to what we just covered in here. We have these pullbacks. It's just that inside of these pullbacks, there are little pullbacks that get you confused. Let's go and take a look at what this looks like in the actual market. So imagine for a second that we have a low down here, we have a high here, a low here, higher high. So we're bullish, right? Let's just say we're bullish. Now, here's the thing that throws people off. For me, it goes like this. Low here, here's what people think. People use this high, and then this low, and then this high. And then when price puts in this low down here, they're like, okay, great, we've shifted bearish. Let me look at shorting. It's like, no, it's not this here. It has to have at least 3 candles that pull back. So it's high, low, higher high, higher low, right? Again, same thing. People will look at this, they're like, okay, oh, low, oh, high, oh, new low, okay, bearish. It's like, no, this is the low. This is the high. If it's above this low, it's bullish. Don't use anything else. Everything else is internal. It's like all these traders are looking at these structural points, trying to use these, and it's like, no, none of that is structure. It's just noise for you to get distracted in. If it's above this low, it's bullish. Until it breaks above this high, this is the low in control. And then for me, it's higher high. But again, many people are looking at this, are like oh, new high, oh, new low, oh, new high. It's like, no. It's like, when we break this high, this is the low. So now the structure is like this. From this low to this high. And then we break structure. You can see that we're respecting our structural levels. Then what happens? Price comes back, we put in a low, we go again, we find a high. And then we have high to low. And price cannot break out of this level. We wick, that doesn't count. We wick, that doesn't count. When we break and close, that's good. So now we go to bearish. And so again, my structure becomes low, high, low, high, low, high, low, possible high, we don't know until it breaks it. What do many other traders look at? Many other traders are looking at it like this. Okay, low, high, low, high, low, high. It's like, you're just going to confuse yourself. That's exactly why you get stuck, because you're using all of these rubbish terms for market structure. No, none of that is market structure. This is market structure. It's the external swing points. Forget the internal. The most important part of trading is being on the right side of the market. And yet you're getting caught on the wrong side of the market because you're not doing this. You're using all of these internal structural points. Just don't do it.
Let me interrupt you just for 1 second. Just before we move on to the next idea, I want to share something with you that will make your trading 100 times easier and simpler. And yes, I truly do mean that. Over the past few years, you've probably come to know me as someone who is very big on market structure. You're watching right now a market structure breakdown. Now, one of the biggest issues that I have seen traders face time and time again, which they keep coming to me with, is this is great. Market structure is incredible, but how do I know how to accurately draw a high, how to accurately draw a low? How do I know what's an actual break of structure versus what I think is a break of structure, but really it's not? Basically, how do I actually have rules in place that make market structure completely accurate? And I've actually gone and created an entire solution for this. And I just want to quickly show you just for a second. So here we are, euro dollar. This is ultimately what price looks like. And you can see in the top left here, we have an indicator. And if I just literally toggle this indicator, it will give me all of the highs and lows, the real highs and lows with the real changes of characters and breaks of structures that completely tell me what the direction of price is, what the market structure actually is. You can see here, it gives a little symbol up in here to tell us what the structure is. And so you can see if you were looking at this price, for example, price looks to be bullish, right? Who in their right mind would know that this little area in here is a pullback? If you didn't, you'd probably be trying to buy all of this price leg. But no, this indicator will show you we literally have a change of character and then a break of structure, and we continue bearish all the way down here. And we knew about it way ahead of time. And then actually we've just recently shifted bullish, and it has the external structure and all of the internal structure as well. And you can see we shift bullish and price begins to trade higher and higher. And so we've literally created a completely rule-based indicator that you can use that will make your market structure and your trading 100 times easier. Feel free to check it out. I'll leave the link in the description. It'll give you everything you need to know about the indicator and how it actually works. Enjoy the rest of the video.
The next super important point that I need to make is that you have to combine structure with supply and demand. Market structure alone won't work. Fibonacci's, it's not going to work. You need to use supply and demand. So what is supply and demand, and how do you combine it with structure? So you can see here that we have a low, a high, we make a new low, and then we make a new high. Now notice in here, we have this area of price where price has a lot of volume before an aggressive move. Price comes back up, we have another aggressive move. We want to look at these areas of demand, right? What is demand? Demand is, a group of people or one institution flocking to buy a lot of something at one price, therefore it moves higher. Simple supply and demand in economics. If there is more demand than there is supply for that thing, the price will increase. So just look at where you have sharp, aggressive price increases. There you will find demand. And so what you want to be looking at is when you have these large impulsive legs, look at the volume that took place just before that impulsive move. There you will find your demand. The same can be true for supply. If you look at supply, you just want to find the areas of price that we were trading at before we have the aggressive move, and there you will find supply. And you'll see interactions with that. And then demand comes in, right? So what you need to do is when you see market structure, you need to then identify areas of supply and demand. And now I'll show you what that actually looks like. So if we come back into this same price action and we apply the same principles, here's what we'll find. Remember, we have our market structure as high, low, low, right? It's a high, it's a low, it's a high, low, high, low, high. Now you need to apply supply and demand. So for example, here we have a bullish move in here. Now where's the bulk of the volume before that happens? It's in here. So there's your demand. You want to wait for price to come back into the demand before you can long. Here we don't have price come back into the demand. Okay, fine. Then we see price pull back and then aggressive run up. Where's the bulk of the volume happen before that happens? It's in here, right? This is the area where we have the transactions and then price aggressively moves. So there's your demand. So after you get the run of that high, you wait for price to come back to your demand. Here's a critical mistake that a lot of traders make as well, is when they're trading market structure, they think, okay, cool. Let's say that's my high, then I should just buy when price breaks above it. So they buy here, and maybe they put the stop loss below here. The problem with this is number one, your risk to reward is low. And number two is where do you target? You don't have an area of price where you now expect that price should trade towards. You don't. You're just guessing. And so maybe you're going for, let's say, a 1 to 3 risk reward, and price comes back up here, and now all of a sudden you move your stop loss to break even, and price comes to take you out of break even. and then it goes in your direction, right? Or maybe you go for a 1-to-1 and great, you make it, but how many of those trades are you going to make? So the problem with those traders is they're buying too early. You don't want to be the first one to the party. It's like a game of poker. With trading, you have the ability to wait for the market to show you its hand. Then you can bet chips. That is the game of trading. You see, trading is very similar in nature to gambling, but there are gamblers out there, professional poker players, who make millions and millions of dollars because they understand probabilities and they understand psychology. Well, the market is not too different. It's probabilities and psychology. The bonus with trading is you can wait for the market to show you its hand, right? Sometimes it may bluff you, but a lot of the times it will show you what it's going to do before it does it, and then you can decide whether or not you're going to take that bet. I mean, imagine for a second you were playing a game of poker, me and you right now, and let's say I bet $1,000, and before you decide whether you want to match that bet, you get to see what cards I have and what is on the table. And then you can decide, well, either I have a better hand than him or he has a better hand than me. If you have a better hand, you can bet your money. If you don't have a better hand, be like, no, fold. The market gives you the chance to do that. So that's what supply and demand and market structure combination is all about. It's you wait for the move, and then you wait for price to come back into this area, so then you can catch the long move in here. You don't have to enter the market early. And sometimes that may mean that you miss out on opportunities because price goes and it doesn't come back. That's fine. That's part of the game of trading. It's about an edge. So same thing happens again, right? Now we have multiple areas where price increases. We have aggressive move in here, we have consolidation, aggressive move, consolidation, aggressive move. So we have phase one of demand really and truly is this entire level in here, right? From the sell down here to the buy. What happens? We have aggressive move out, we come back into the demand, and then we trade away. Then we have a new demand, and that new demand is pretty much this range here, right? This is the next level where we get consolidation and then large moves to the upside. That's demand. Price goes up, we consolidate, and then we go aggressively again to the upside. That's demand. Now notice that price doesn't come back and tag us in here before it goes. That's fine. You're not going to get that every single time. Then what we have is the next phase. We have aggressive demand. So what we have here is we have consolidation, a small aggressive move, which is demand in here, and then price comes into that demand, and then we have aggressive move again. Now the demand is where? From this area here to here. You could also, in this instance, use this entire leg of price, right? This is the consolidation, and then you have the aggressive demand. And so it's like, okay, you just wait for price to get back into that area where price moved from, because this is the area where the buyer steps into the market and the market became imbalanced. Market seeks equilibrium, right? Comes back into balance, and then we get the next leg up, probabilities of market structure. And that is essentially how you combine supply and demand. So it's very simple. The final principle that I want to share to you before we put this all together is confirmations. You see, it's one thing having market structure. It's important, it's great. Alone, it's not going to help you. Then you add supply and demand, and now it becomes even more powerful. But alone, it doesn't help you. Imagine you have market structure with supply and demand plus confirmations. Now you have a cheat code. So what is confirmations and how does it look? Well, same thing applies, right? We have a low here, a high, we have a new low and a new higher high. So the market is bullish. We have a break of structure above the highs in here. Break of structure, great, we are bullish. We are looking for longs. Second thing that we do is we find our area of demand. So here we have a very aggressive and bullish move up. But just before that happens, we have an area of consolidation where we may see institutions or certain individuals loading up on their positions, where the demand really kicks in, right? So this is our area of demand. Now here's the catch, right? Let's say that this in dark here is the 15-minute time frame. And let's say in the dotted line here is the 1-minute time frame. What's going to happen is when you have price action like this in the 15-minute, when the 1-minute comes back here, it's going to be bearish and it's going to look like this, right? So on the 1-minute time frame, as price approaches your area of demand, you simply apply patience. When we get in here, you can see that we're bearish, right? Lower low, lower high, lower low, lower high, lower low, consolidation, lower high, lower low. Inside of our demand, you simply wait for this confirmation. When this high gets broken in here, now you have literally a cheat code, because this is really what my model is, right? This is honestly one of my most powerful trading models. Now you have confirmation on top of everything. So we already know that probability indicates that we are going to trade into this high. We already know we're bullish. We already know that we're trading from an area of demand. Now we've confirmed that we're going to trade higher because price is trading higher. We've confirmed that this demand area is valid because we're seeing demand come back in from that same level. Now all you have to do is trade. And so again, a big thing that traders do wrong is they try to trade like this. 15-minute time frame, bullish, find the demand area and trade like that, right? 1 to 2 risk reward. Or maybe sometimes what you'll find is that you have multiple areas of demand in the same price leg. Now what do? When you wait for the lower time frame, you have something different. Because now what I can do is I can use this same structure and I can use this same, let's say, area of demand on the 1-minute time frame or the 5-minute time frame. And I can take this trade, the same trade idea, but different entry after confirmation. So now what I have, by adding this confirmation principle, which so few people do, I am increasing my risk to reward from 1 to 2 to 1 to 5, and I'm further confirming the likelihood that I win this trade. So I've increased the likelihood that I'll win, and I've increased how much I'm going to win just by adding this one principle. And that is essentially it. And then you patiently wait for price to come back in and then take you away to your direction, which is already mostly confirmed.
You're struggling to understand liquidity because you want to become a consistently profitable trader, and you know that liquidity could be the missing key between you and profitability. But up until now, you're lost and confused because everywhere online, everybody seems to make liquidity such a complicated idea. Well, stick with me because in this video, I'm going to simplify liquidity to a point where it's very easy to understand. In this video, we'll cover what is liquidity and why it works. Then we're going to cover the most common types of liquidity and how to identify them. Then I'll walk you through the biggest mistake that I see traders make when it comes to liquidity and how you can avoid making that same mistake. Okay, concept number 1, and again, a very, very simple concept, is what is liquidity in trading, right? You first and foremost have to understand what exactly it is that you mean by liquidity. So what do we mean by liquidity in trading? Simply put, liquidity just refers to money. When you want to identify areas of liquidity, you need to ask yourself, where is the money? And money in the markets can only come in the form of 3 different ways. It can only come in the form of entries, stop losses, or take profits. Every time you get an entry, you deploy liquidity into the market. Every time you hit your stop loss, you deploy liquidity into the market. Every time you hit a take profit, you deploy liquidity into the market, and so does everybody else. So when asking yourself how to identify key areas of liquidity, what you really need to ask yourself is, where is everybody's orders, where is everybody's take profits, and where is everybody's stop losses? And that is exactly what I'm going to show you. So this is a very simple diagram of understanding the most common liquidity concept, which is dumb money, right? What you want to be thinking about is, where is everybody's stop losses? Where is dumb money stop losses, right? Where are their orders? Where are their stop losses? And if any of them are in profitable positions, where are people looking to take profits, right? Liquidity is actually a very psychological thing. You have to understand that groups of traders form collective biases based on trading ideas, ideologies, and strategies. So many different traders trade many different strategies collectively. So you can identify these strategies and begin understanding where all the liquidity is. If we know that liquidity equals money, stop losses, entries, take profits, we need to identify where are people putting their orders, where are people putting their stop losses, and where are people putting their take profits. And so here are some very simple ideas of how you would identify some liquidity. Then we'll go and take a look at what this looks like in the markets. So you can see here, we say, we have a price leg, push up, pull back, push up, pull back. Right, so you can quite clearly see that, from our landscape, smart money, we're bullish, right? We can see we have bullish market structure, but what we have is we have this trend line forming down here. So there are a lot of traders that are looking at this and they're seeing this trend line. And again, these are the trend line traders. And many of these traders, when they're looking at this market, they have an ideology of wanting to go long. Their trading strategy indicates to them that price is going to continue trading higher. So what do? Well, they're going to wait for one more touch of this trend line. They're going to try and, probably enter into, try to get the next touch. So we have 1, we have 2, we have push up. So maybe they have their entry somewhere in this region in here. Maybe they're looking at, this old low down here as an area in which they could potentially look at putting their stop loss. And where do you think they're probably going to target? Well, psychology indicates that many traders use old highs, old lows for their take profit placement and their stop loss placement. Think about it. Think about you as yourself. Where do you place your stop losses? You place your stop losses at some sort of low, which you think should be respected. You place your take profit at some sort of high you think should be disrespected. Well, all traders pretty much think very similarly. So this is what the typical kind of trend line trader who would be looking at this would be looking at. Then you have the opposite side of the spectrum. You have a certain caliber of trader who's looking at this market and says, okay, well, we've been trading high for a long amount of time now, and we begin to reject this random key level, right? This random key level that they created from the past that has no relevance of current price action, but let's just say it means something. They have these key areas mapped out. They say, okay, price is rejected from this key area, and then price is pulled back into this same area and rejected it again. So that must mean that this is a key level. This is an area of resistance. This is a double top. This is an area that is protected. So I want to get involved. So they try to get involved in some sort of short position, right? So they may put their entries up at this level when price comes back. They're probably going to put their stop losses at the highs up in this level. And then they're probably going to put their take profits, anywhere, kind of some old lows, wherever they may put their take profits. But then you're going to have something that looks a little bit like this, right? You're going to have some traders who are looking to long because of this trend line. You've got some traders who are looking to short because of these, relatively equal highs or this double top or this area of resistance, right? And then what else do you have? Well, maybe the market then gives you something like this. You have a little bit of a reaction, right? And then what happens? What happens is a new caliber of trader also enters the market. A new trader enters the market and goes, oh, look, we have this trend line. We're bullish. We have structure. They have an understanding of structure. We have some great structure. Amazing. And now prices traded out of here. We've come back in. Now we're having a little bit of a reaction. So what am I going to do? I'm going to long this reaction, right? So then they're trying to get involved. And so we can literally just paste this again. Now we have another caliber of trader trying to get involved, put in their stop loss where? Probably at this low. Entry somewhere around the same level. Take profit somewhere at this high, right? That's another type of trader. Then again, you may have more of the same trader, let's say trend line traders, right? So you've got 1 touch, 2 touch, 3 touches. They're looking at getting involved and they're waiting for what? They're waiting for some sort of reaction from this trend line point. And so when they begin getting this little reaction, again, that is when they may jump in the market and where they're going to put their stop losses in these similar areas, right? So what I'm kind of building the narrative for you is understanding that something as simple as 2 legs on a price leg can have so many different traders getting involved in the market for so many different reasons. And it's your job to identify who those traders are, what strategies they likely trade, where their entries likely are, and where their stop losses likely are. And it sounds difficult, but it's actually very simple. All I've gone through is a trend line trader, a resistance type trader, a double top, a double bottom, a trend line confirmation, right? Very, very simple level trading strategies that a lot of traders try to trade. And these types of things, these patterns that you see, they're set up intentionally. They're set up on purpose because smart money knows that the information that you're getting online, the information that your broker's feeding you, it's all retail-based concepts or dumb money-based concepts. It's all pattern recognition. There's no causation to the price movements. Everything is, trying to identify something based on something that doesn't exist. And so it sees all of this liquidity that's building, all these different type of traders that are trading these outdated styles of trading with all their stop losses and their entries. And smart money knows this, right? And so we have all these different pockets of liquidity in just one random scenario. And so now what you have is a bunch of stop losses in here. You have a bunch of take profit levels in here, right? You have probably a bunch of take profit levels in here from sellers. Then what else are you going to have? Well, any market movement that we get from here on out, now you've got the traders that are kind of waiting, right? The breakout traders or the break and retest traders. And what they'll be waiting for is some sort of direction. For example, If price continued trading higher and broke out of this high, so many traders would jump involved and start longing the market up in these regions. When it breaks out, they long, they may put their stop loss below this low. They may put their stop loss, inside of some internal low inside of here. But basically, they are going to be longing and they are going to be putting stop losses in these areas as well when it breaks, right? Again, you have the same thing on the opposite side. When the market, let's say, has some sort of continuation and then it rejects from here and it takes out these lows, what you're going to be getting is you're going to be getting all the breakout traders that are trading this breakout, and they're getting involved in the market here. Their stop loss goes above these highs in here, right? Their take profit goes, down here. And then again, you have the break and retest traders, right? Those are the ones that wait for the price to break, but then they wait for it to come back, right? And then they go to short. And it's the same thing. They have their entries in here, their stop losses up here, their take profit levels down here. So you can see just in this one little schematic, how many different traders would read the same piece of data and all come to different conclusions. But primarily what we're seeing is they're all putting their money on their bias, right? They're putting their money in these levels. Now what I want to do is run you through the simple framework in which I use and is which, what Smart Money Concepts is about, in how we would interpret this exact same price action so much more simple just by understanding liquidity and understanding all the other types of traders and where their stop losses are. And it goes something like this, right? First and foremost, you have to understand, why is that liquidity? Why before a very big move, and this is something you've probably seen, right? You may have been long before, you had a bias to go long, and you had your stop loss in here, and then price just come into your stop loss before going in the direction that you wanted it to go. And you probably sat asking, why does that always happen to me? This is the reason. The reason is because before smart money move the price aggressively in a certain direction, right, which is their bias, that's their intention, it's their footprint. Before they do that, they will engineer liquidity on both sides of the market for this purpose. You see, smart money are very, very big players. When they move a large amount of money. And the market is very simple marketplace. It is pretty much for every buy order, there needs to be an equal sell order on the other side. And so because smart money have so much money, let's say they wanted to, buy euro US dollar long term. Well, they would need to get their orders filled at the price they want to get their orders filled at. So let's say they want to get their orders filled at this level here, and they want to buy here. They need an equal amount of sellers to be present at that level so that they can get their orders filled. So what they do is they create artificial dealing ranges, right? They'll push price in a certain direction to trick people into having an opinion, having a bias, because when they have that bias, like we've just looked at, all these different traders that are looking at this market, and lots of them have stop losses here, entries here, take profits here. When they've been able to manipulate their thinking to put in their liquidity into the market, then they're able to use that liquidity to get a better average of their orders filled at the prices they want to get their orders filled at. Because if they wanted to buy, and they first sold, they created these patterns, they created these little equal lows here, they had their little push up to make everybody, ready to want to buy in here. And so they have their stop losses down here. And then anyone who sees it break now wants to sell. They do that so that then when they move price into here, into where they really want to buy from, right? Then all of these sell orders from the stop losses of the buy orders, from the sellers who are getting involved because they think prices go lower, they absorb all of that liquidity with their buy orders, right? That is the game. So that is why they manipulate price. It's not just this kind of like conspiracy theory as why it works. No, there is literally the reasoning and justification behind why price does it. So how would we view the same market through the lens of smart money? Well, number one, directional bias. That's always number one. We need to understand what is the direction of the market, because one thing that smart money can't hide is they can't hide their intention. They can't hide their footprints. Because the reality is when they move the market moves. You can't hide that. So if price is trending in a certain direction, like you can see here, right? We have a swing low, swing high, higher low, higher high. When price is put in this structure, it's undeniable that the market is bullish and that it's going to have higher prices because that is their intention. It's undeniable. They've already shown us. They can't hide it, right? So our directional bias is our first and foremost bias that we need to have. So in this scenario, you can see that we're bullish. So our directional bias is bullish. We are looking for long positions. But then when you see price begin to build these little internal ranges, what we see is we see trendline liquidity across these lows, right? So we can put liquidity across here. We have all of this liquidity down here, trendline liquidity. We have equal highs across the highs up in here. We have, relatively equal lows in these areas in here, right? Liquidity. And then we have probably some sort of reaction in price that pushes more buyers into the market, stop losses under here. We identify all of this in the same lens that I've just shown you when we mapped out all of the dumb money. And then we identify, okay, where is the area in price where we can avoid all of that liquidity that includes taking out all of that liquidity and is below that area of price? We would identify an area of interest, right? An order block, an area of interest below areas of key liquidity. And then we wait for everybody else to get stopped out, or most people to get stopped out. And then when price gets into our area, we wait for some confirmation. And then we go long, right, into here. And then we wait for these guys to get manipulated. We wait for these guys with the stop losses here to get manipulated. And then we get in with the real move of smart money. And we just target the next logical area of price. And that is literally what my smart money model looks like. And that's something that we'll get into in just a moment. So to recap, liquidity is money. And money is stop losses, orders, and take profits. You want to see where the liquidity is? Get in the minds of dumb money. Where are they putting their orders? What trading strategies are they using? And once you can see that in the charts, the trend lines, the equal highs, the support, the resistance, right? Once you can see those patterns, then you can begin to ask yourself, where would those guys put their entries, their stop losses, and their take profits? And those are the pockets of price you need to mark out as your liquidity, because that is where there is resting money sitting. And smart money, like a shark, is coming for those pools of liquidity. So why everyone gets liquidity wrong and what you need to do to make sure that you don't fall into this trap. The key is they have no context, right? So if we look at this diagram that we have right here, what we can see is that, we have equal lows down here, right? So this is an area of, old level of support or equal lows. So we know that's liquidity. What do we have? We have trendline liquidity building, right? We have a lot of trendline liquidity building. So again, we know there is a lot of liquidity. And even if you zoom out, you can see on the bottom side of things, you can see actually this is one big trend line as well. So we have one big trend line, we have micro trend lines within it, we have equal lows, we have again this large trend line down here. And what else do we have? We have equal lows across here, right? So more liquidity, and we have equal highs across here. So more liquidity. So these are our pockets of liquidity, is what I like to call them. These are the areas in which there is liquidity. But the issue that a lot of traders make, and maybe you're making this yourself, is you think that because you have these areas of liquidity mapped out, that now you think you know where the market is going, but you lack context. You think that just because there is liquidity in a certain area, that means price has to go there, or price will go there, and price will go there now. And that's where many traders are wrong, because what they'll try to do is they will try to trade solely based on understanding liquidity. They'll say, okay, I see that there are stop losses in here, therefore the market is going to trade there. When the reality is you need context. Everything needs to be seen through the lens of context. Because here's how I would see it. If I look at this market right now, I would tell you step number one, always form your directional bias first, like I've just explained to you. So it would be step one, identify our key areas of structure. Where are we trending, right? So we have swing low, swing high, swing low, higher high, higher low, higher high, higher low, higher high. Great, we're bullish. Now, where is my most recent swing range, right? I need to find the swing low to the swing high. So where's my most recent? Well, my most recent swing low is here, and my most recent swing high is here. So now I have my trading range, and this is the current present moment trading range that we're operating in. So if we're bullish and my swing low is here, my swing high is here, as of right now, right this moment, none of this sell side liquidity is important, right? Ignore this because it's not in context. There's no reason for the price to go lower until it's shifted its structure. So focus on market structure as your primary foundation. Market structure is like the building blocks of your trading strategy. Again, if you want more value from market structure, I have so many videos on the channel about it. But market structure is really your building blocks. And, you know, with it, we can see we have a swing low, we have a swing high. So that is our trading range. Inside of that box is our trading range. So I am now only interested in number one, longing this market because market structure is bullish. Number two, which simply means now I have context, I'm only interested in the liquidity areas inside of my price leg. So if my swing low is swing low to swing high, I'm not interested in any liquidity that is outside of that context, right? So what am I interested in? I'm interested in these lows and I'm interested in these highs. And again, like I said, many traders will make the mistake. They'll think that because all of this liquidity is down here and here and this long trend line that they can short because price is going to go there. And you know what? Price probably will go there. But it's not about understanding where price will eventually go. It's about understanding and becoming profitable is about knowing where price is going to go now. Where is its next move? That is how you make money. You don't make money by knowing when it's going to go in some random future point in time because there's a random trend line there. Because maybe it will go there. But by the time it's gone there, you've probably lost so much money that it doesn't even matter. So everything must be understood through context. And context is market structure. We have to understand that we are bullish. So until we have a change of character, until price shifts bearish, we don't care about the sell side liquidity that's at the bottom of the price leg. We'll cross that bridge if and when we come to it. Right now, we want to focus on what is in our control. And in our control right now is understanding that price is probably going to trade higher short term. And we need to get involved in those long positions to make money today. So how do we do that? We identify the areas of liquidity. So we have equal highs. So we know there is a lot of stop losses above here. We have equal lows. So there's a lot of stop losses below here. So what I would be doing and I would be framing is, okay, I want to long the market. Awesome. I want to probably be buying in an area of discount. Okay, so down in these regions in here. I want to identify a point of interest, right? An order block, an area of interest. Again, many videos on order blocks and areas of interest. I want to identify a key area of liquidity, which is these lows, these highs. I want to identify my order block inside of my discount level. And then I want to patiently wait for price to sweep that liquidity into my point of interest. Then I want to get my entry model, right, which is my lower time frame confirmation. And then I want to buy using that. And again, what is it? It's the exact same model that we just looked at, right? We're waiting for the liquidity to be taken, and then we're waiting for the liquidity to be targeted. So that is why everyone gets liquidity wrong, because they lack context. And hopefully that gives you an understanding of how to incorporate context into your trading. Liquidity sweeps are the most powerful way to trade the market, and yet 99% of traders who try fail. The reason is because there are hundreds of different liquidity sweeps that happen every day, but most of them don't work. It's only when you truly understand which one does that they become unstoppable. It took me years to figure out which ones work and why, and today I'm going to share that exact blueprint with you. Now, you hear people talk about liquidity and they make it out to be such a complicated process, when in actuality, it is super simple. Liquidity simply refers to money. When you're looking for liquidity, what you're looking for is money. And here's the truth. Liquidity is absolutely everywhere in the market. The thing is, it's just in some areas more than others. So when we're looking at liquidity, we want to be looking at areas of large liquidity. Now, how does liquidity enter the market? Liquidity enters the market in one of three ways. The first way that liquidity enters the market is opening a position. So anytime that you have a buy order open or a sell order open, whether it's a market execute, a buy stop or sell stop, or a buy limit or sell limit, when that gets triggered into the market like this, at that moment in time, that is your injection of liquidity into the market. And so let's say you're buying, for example, or you're buying into the market, which means you're putting your liquidity into the market. There is a counterparty on the other side of the market who's telling the opposite side of the trade. So if you're buying, 10 lots on euro dollar, there has to be someone on the other side of the market selling you those 10 lots. That is usually a market maker. That is their job. A market maker is there to provide liquidity to whoever needs it, to make sure the order book is stacked so that anybody can get access to the market and they make their money off the difference between the bid and ask. That is a market maker. So when you enter into a buy position, that is you entering buy side liquidity into the market. The second area of liquidity that comes into the market is when you hit, let's say, a take profit. So when you hit a take profit, which is the area that you have agreed upon to close out your trade in a profit, when you hit that take profit, that acts as sell liquidity. So you're buying your 10 lots worth of euro dollar at this price, and you're selling back those same 10 lots to the market at a new price. And so at this point in time, 10 lots of sell side liquidity come into the market. The third area that liquidity enters the market is when price hits your stop loss. So let's say you get triggered into a buy position, and for many of you, you may be experiencing more stop losses than not. Every time that you hit a stop loss like this, when price tags you out of that position, you are indeed selling your 10 lots back to the market at a loss. So you brought 10 lots here and you're selling the 10 lots back to someone else in the market at this price, and you net the negative difference. The same is true for a take profit. When you hit it, you're selling those same 10 lots at this area for a net positive dollar return. So that is the three different ways that liquidity enters the market. So that's liquidity. Liquidity is money, and that money comes in either through entries, stop losses, or take profits. Now you have to ask yourself, where is the most available liquidity? That is when you have to try to understand the other market participants, because liquidity, as we've said, is orders, and orders are placed by someone. And there are commonalities in market participants' behavior. And so here are the most common areas of liquidity. So the most common is highs and lows. At any time you see an area of price like this, where price is moving in this direction. Let's say price has a little bit of a pullback like this. The most common areas of liquidity at this moment in time are below this low and above this high. That is where the most liquidity is resting in the market. The reason behind that is because most market participants like to put their stop losses or their orders at highs and lows, just the psychological element of safety. So buyers that are stepping into the market and expecting price to go higher, when they enter the market, the likelihood is they ask themselves, where should I place my stop loss? And they are going to be looking to place their stop loss in a logical place, which is usually below a low. Now, sellers who are entering the market in here and they're entering sell positions in here, they have the same question. Where should I be putting my stop loss? And then for most of them, they're going to answer the same thing, in the most logical and safe position, which is usually above the high that they're selling from. Then you also have, when these buyers are entering the market, they're putting their stop losses down here. Now they have to set a take profit level. And that take profit level, again, usually comes at a high. So they're saying, I'm buying here. If it hits this point, I'll exit the trade. So there is, again, more liquidity at that high. So now you have take profit levels and stop loss levels. And then the same for this low. You're having stop losses, and anyone who's selling from this region, right? A lot of people are placing take profit levels in this area. So that is more liquidity. So you have stop losses and take profits at the low, stop losses and take profits at the high. Then there's another form of liquidity that comes in at highs, and those are your breakout traders. So breakout traders are typically people who look at getting into the market based off of a break of a high or a break of a low. So let's say, for example, price move like this and price enters into this high, there will become breakout traders. So at this level, you will see people who put buy stops in place that says, if price trades past this level, I will get entered into my buy position because they're expecting that if price breaks this high, the trend is likely to continue. And so now you have the take profits of the buyers who brought in here, you have the stop losses of the sellers who sold in here, and you have the entries of the potential buyers that are going to buy on the breakout. And so you can see how all of this liquidity starts piling above this high. The same is true on the opposite side of the market. If price enters down into this area in here, there are going to be sellers waiting for this price point to break so that they can get involved in sells and try to trade with the trend. When we trade through this area, their sell positions will be entered into the market at this level. So now all of a sudden, at this low and at this high, you have down here, you have stop losses, you have take profit levels, and you have entry levels. So you can see how there is a lot of liquidity that rests just on the dependence of this low. The same is true for this high. Stop losses, take profits, and entry points. So there is a considerable amount of liquidity resting at highs and resting at lows, as opposed to less liquidity that may just sit inside of the price range. Inside of the price leg, usually most of the liquidity is going to be in the form of entries. So people who are entering inside of the price leg, as opposed to people who are looking to break out and place their stop losses or their take profits. And so that's why the most common form of liquidity is going to be your highs and lows. Another way to look at highs and lows as liquidity is equal highs or equal lows or support and resistance. Pretty much the same thing. When you get price moves like this one in here, and then somewhat of a reaction to the downside. When you get something like this, what happens is another form of market participants join in and the load gets even larger, because as this high gets respected and starts trading away from it, well, now you have different characters entering the markets. You had the old sellers that had their stop losses. You're going to have the old buyers who place their breakout trades. You're going to have the other buyers who place their take profits. Now you're also going to have new sellers who step into the market because their strategy is equal highs, or their strategy is an area of resistance. An old high that has traded back into and had a reaction induces a lot of market participants to come and trade and participate in the market at that level. And guess what? They too are placing stop losses above these highs. The same again, more breakout traders come because now this isn't just a single high, it's equal highs. It's an area of resistance. So if we break out at this level, more traders will come because the breakout now isn't just a high, it's an area of resistance that they will hope gets turned into an area of support. Or the equal highs being taken out is a stronger sign of bullish momentum, which induces more buyers. So you have equal highs, and then sometimes you'll have the same for equal lows like this. You have equal lows down here, and that's going to give you the exact same. So what you want to be looking for are lows, highs, equal lows. Some other forms are, trend lines and some really powerful sessions, right? Because not all highs and lows are the same. Not all highs and lows are equal. There can be prioritized highs and prioritized lows. I'm going to dive deeper into that in phase 3. So what is a liquidity sweep? And more importantly, why do they happen? Let's first start with what actually is a liquidity sweep. Very, very simply put, a liquidity sweep is when price breaches a high, fails to close above that high, wicks above that high, and then closes back inside of the price range. The opposite can also be true in a bearish example. Now, that is what a liquidity sweep looks like. That's the easy part. That's what everybody understands. Everybody understands what a liquidity sweep is, but very few understand why a liquidity sweep happens. To understand this, you need to understand the basics of an auction market theory. Essentially, for every buyer, there must be a seller. Meaning, if you want to buy 100 lots of euro dollar, there must be someone on the other side of the market willing to sell 100 lots of euro dollar. This could be 100 different people all selling one lot. It could be two bigger people looking to sell 50 lots. It doesn't matter how many people. All that matters is how many lots are available at any one price point. Now that you understand that every buyer needs a seller and every seller needs a buyer, you need to understand how an institution operates. You see, institutions, when they want to place large orders in the market, they know that they have large volume. That means that if they want to place a position, it's going to be a big position. But for them to do that, they need somebody on the other side of the market to take that position. Well, what do you know? We understand that at highs and at lows, there are these large liquidity pockets. What is in those liquidity pockets is a large amount of orders. And so if an institution wanted to sell 100,000 lots of euro dollar, let's say hypothetically, well, if they just sold at market price, here's what would happen. So this right here is the order flow. This is what's actually going on in the market. This is what the real market looks like. I'll throw a picture up of the real order flow right now. As you can see that this is a simplified version of it because I need to explain something to you. You see, every single candle that you see, every phase of candles, this is independent of time frame. So if you're on a 15-minute time frame, this is a 15-minute candle. And inside of this 15-minute candle, you will see the 15-minute order flow for that candle. Let's say that they were daily candles. So inside of this would be the daily order flow. And inside of the daily order flow, you would see this. Now, inside the market, inside the order flow, you will see the bid and you'll see the ask. The bid is the demand. Those are the people who are willing to buy, right? They are bidding on price. Ask is the sellers. They are the ones who are selling. They are asking for the price. Hey, my asking price is this in order to sell. And then the price is the price. So at any one point in time, price will be sitting at any one point in price. That price is considered fair value by both market participants. And here's how it works. The market is comprised of two sides, active and passive. You have active buyers and passive buyers. An active buyer is someone who will step in at the current market price and execute orders. They don't care about waiting for price to come back down to a certain level. They want to buy right now. And so they are willing to buy at a premium. Same for sellers. Active sellers are willing to sell at this specific price right now. They're not waiting for price to come back. Passive buyers and passive sellers are people who are waiting for price to come into a certain area and then they will buy or then they will sell. So when you're looking at the order book, you'll see all of these pending orders. What these are potential fills. Meaning at any one point in time, these orders can be removed unless they get triggered. When they get triggered, then they get activated into the market. So here's how it works. And here's how you see a candle actually get formed in real time. This candle, the new day, is opening at 104 like this. What happens is at some point in time, let's say an active buyer steps into the market and they want to buy, let's say 50 lots of euro dollar. And so they want to buy right now 50 lots of euro dollar. Well, there is nobody at 104 willing to sell. So what happens is the price seeks the next block of liquidity like this. And then you see the candle move and this then becomes a bullish candle. So you see that we come up into here and you see there are 9 lots here. Well, what happens is these 9 lots go to 0 and whoever was selling these 9 lots, they get filled on their sells. But this trader here still has 41 lots that are left unfilled. So then if there's no sellers here, then it's going to go to the next block of liquidity. And then it's going to go to 106. At this point, there are 40 units to sell. And so these 40 get consumed and they go to 0. And all of these sellers get triggered into their trade. But there's still 1 unit left unfilled. And so price has to go to the next available block of liquidity to take that. And one of these 30 units will get triggered as a sell. And then there'll be 29 left at this price. But the reality is there's nobody willing to buy from them at this price point. So they don't get filled. So if sometimes you ever wonder, you take a trade and prices hit your entry, but you still don't get filled into your position, that's because there is no liquidity available for your order specifically to get filled at that price point. Then let's say, for whatever reason, this is our high. So we're going to map out this right here as our highest point of price. And then we're going to do it to the low of price right here. Then let's say an active seller comes into the market. And let's say a seller steps in who's willing to sell at this specific price for 50 lots again. And let's say there are, like 4 lots or something at this price point. Then what happens? Price goes and seeks where the liquidity is. So there's no buyers in this price point. So price skips this level. Inside of here, there are 4 lots. Those 4 lots get consumed by the 50. We're still left with 46. Then you have 7 in here, 9 in here, and 10 in here. Not enough to fill the 50. So price comes into here to collect the 7, the 9, the 10, whatever it is. And then this is where price ends up. Now that once bullish candle then turns into a bearish candle. And that is essentially how the candle gets formed. Now, why this is important is because I need you to understand something. Let's say, for example, a large institution steps into the market and they actually want to buy 1,000 lots worth of euro dollar at this point right here, right? 1.01. That's their target price. When institutions come into the market and they build a position, because institutions don't just place a trade, they build a position. I'll explain why in a moment. So they've got an intention of placing 1,000 units of euro dollar and they have a target of 1.02 to be their average price. Now here's what happens. Let's say there's 100 in here, 20 in here, 50 in here. The likelihood is there isn't enough liquidity available on the other side to fill those 1,000 orders. So instead of the institutions coming into the market and placing all their 1,000 at one time, because what happens is if they do that, price would end up going from here and absolutely skyrocketing all the way up here. And then all of a sudden, they might have got filled 20 down here, 30 here, 100 in here, 300 in here. And all of a sudden, their target of getting an average order value of 1.02 completely evaporates. And now they're getting 1.1, right? Completely out of alignment with what they wanted to. So what they do is they slowly build a position. They'll put in 50 now, and then it won't really move price. And then more sellers will step in and they'll put another 50 and another 50 and another 50 and another 50, right? That's kind of how they build out a position. That's why you'll often see that institutions build positions in ranging markets. Now, here's the other thing that they will do. They understand that at these highs and at these lows, there is a lot of liquidity, right? So maybe above this high, there might be 1,000 units to sell at this level. Why? Because you have buyers take profits that act as sell. You have breakout traders that are acting as sell side liquidity as well. So what you'll see is they will sometimes strategically push price into these areas so that all of those units of sells get flooded into the market, and guess who's there ready to buy them up and absorb them? That is going to be these guys. These guys are sitting in here. If this institution wants to, let's say, sell, 1,000 units, for example, at this price point, right? Or in and around these areas, let's say they're in here, what they'll do is they'll nudge price up into these liquidity pockets up in here where they know there is a large amount of buyers, right? There are breakout traders in here. There are take profit levels. There are stop loss levels. There's a bunch of liquidity that sits in here. So they know that they can nudge price up a little bit, trigger all this liquidity, and then take the other side of it to get a good fill of their value. And they'll do that. And they'll push price into these levels, making everybody believe that the market is, bullish, having buyers flood to the market so that they can get their sell positions in. Now, you'll know that this is happening when you see that price wicks above the high. Because what happens is, as price approaches a high and trades above that level, this is where the magic happens. All of the buyers that are stepping in here, these institution is absorbing all the sales, until eventually, guess what? There's no more buyers left at this price point. And so now all there is the rest of the sellers that were sitting at this price point. And so price then comes back down. It closes below this previous high. And that is your telltale sign. Why? Because what the market is saying is that the market and all its participants do not agree that price should be trading higher than this level. They agree that price should be trading lower than this level. And so now the likelihood is that we get an aggressive sell-off that goes in this direction. That is a liquidity sweep. A liquidity sweep is when price aggressively runs a high, wicks above it, and then closes inside of it. But like I said, the why behind it is what's most important, because that, when we get into the next stage, is going to give you a good understanding of context. So understanding that when we liquidate this level and close back inside of the range, that is a liquidity sweep. But like I said, they happen all the time and not all of them work. It's about identifying which ones work and most importantly, why. And I'm going to get to that in just a moment. So that is a liquidity sweep, and that is ultimately a large part as to why liquidity sweeps occur. Now we need to understand what's a run on liquidity. So a run on liquidity and a sweep of liquidity are two very different things. And the reality is most people get these confused, or they call the same thing, they call different things the same thing, not really understanding what is actually going on and what is the difference. So let me explain it to you. Now, you see how liquidity sweep was when price trades over a high and then closes back inside with a wick on the top like this, indicating lower prices. This indicates a rejection, right? A rejection of the idea that price should trade higher, therefore it's likely to trade lower. It's a resistance to that idea. Well, a liquidity run is quite literally the opposite. A liquidity run is when price aggressively trades above a high and then also continues with that same level of momentum. Now, there's two very different dynamics that occur between a sweep and a run. And I want to explain that to you using kind of this order flow in here. So what is a liquidity run and why is that a lot different than a liquidity sweep? You see, a liquidity run is used differently because it's used to fuel a move as opposed to something else. Let's say, you can quite clearly see that we have a low, a high, a higher low, meaning that this low is higher than the previous one, indicating signs of bullish order flow. Then you have a higher high, meaning this high here is higher than the previous one, indicating bullish signs of order flow. So the expectational order flow, right, the structure of price is bullish. So you're expecting higher prices. Well, we know that down here we have liquidity, up here we also have liquidity. Now, the market is bullish, but still there are obviously sellers inside of this price level. So when a seller has their position up here, well, their stop losses act as buy-side liquidity. And then you also have breakout traders that act as buy-side liquidity. And so a liquidity run is when that liquidity is used to fuel a move, right? So let's say, for example, large money institutions were building up a position. And let's say as price is kind of ranging around at these levels in here, they're building a position, they may give a little bit of a liquidation of an internal low whilst they're building their position like this, right? Once they've built their position, they've got a nice amount of orders set to go long. Then what they might do is they might initiate a little bit of a bullish move because they understand that by doing so, that is going to induce buyers to step into the market and allow the market to move in the direction they need to go in. Because once they've built their position, they can't build a position and then also move price, because what would be the point of that? It wouldn't really make much sense for them. So what they do is they build the position, they start the run, and then they let the rest of the market, the herd, take their position where they want to go. So they've built their position in here. They'll give price a little bit of a nudge. Bear in mind, we're already in bullish order flow. So the likelihood is we're going to go long anyway. And so what happens when they give that little nudge is that buyers start stepping into the market. And eventually, when we go through this high, which is the logical phase of price, there is number one, everyone who's already buying and everyone who's rushing to buy late. Number two, all of the sellers that start to get in, that's why sometimes you see a rejection of a high as well, because it induces more sellers to create more liquidity. Well, what happens then is when price reaches this level in here, and all of these stop losses get filled, and all of these breakout traders get into the market, what happens is price runs itself, right? Because the momentum of all the liquidity that gets filled in at this level, plus nobody wants to sell price really after we break out the high. So there's less sellers, right? Which means it's easier for price to increase, and there are more buyers. So you have a lot of buyers, not many sellers, and therefore the price rockets with ease. What that does is that takes this position well into profit, and that is a liquidity run. That is when price aggressively breaks a high, but uses the liquidity that's sitting at that high as momentum to continue. Whereas a liquidity sweep uses that liquidity at a high as a mechanism to get filled on the opposite side of their orders, where you can expect price to go lower. So they're two very different things used for very different reasons. Literally just one candle is all you need to become insanely profitable as a trader. And in this video, I'm going to show you exactly how to understand the one candle rule and how to execute it into a live trading strategy. So without further ado, let's jump straight in. Now, what you can see on screen right here is the trade that I'm going to be walking you through. It's the trade that was executed today, and a bunch of the inner circle students also took this exact trade because of this one candle model. Now, the one candle that I'm talking about is the daily candle, and I'm going to show you in this video how you can use the daily bias to consistently generate income from trading. Now, there are three main things that I want to walk you through in this video. The first one is how to read the previous day's candle to understand what today is likely going to do. The second one is higher time frame magnetism. And finally, the third one is entries, right? How do you actually enter based off of your daily bias? That's when I'll recap the exact trade that I took today. So here I am on the daily time frame, and I'm starting from the 13th of October. We're in early December right now. In fact, this trade was executed on the 3rd of December. And I'm going to literally walk you through every single daily candle to show you how you can predict the next day's candle. And then I'm also going to explain draws on liquidity / area of interest. This is what's going to give you an edge in understanding where the daily might gravitate towards. And then finally, when we get to today, I'll show you how I used this daily candle model and how I was able to get into my position and the exact trade that I took. So starting off plain and simple, predicting the daily candle. You can basically, with a very high degree of accuracy, understand what the next daily candle is going to look like based off of what the previous day's candle looks like. So we'll walk through step by step and I'll explain it all. So we'll start with where we're at, right? Monday the 13th of October. You can see this is a bearish daily candle, and it's honestly very indecisive. So a candle like this and a day like this doesn't really give us any information. We don't actually know what the next day is going to do. We're kind of in a consolidation phase. What I will say is that the market is always ranging from consolidation to expansion, back into consolidation, back into either expansion in the buy side or expansion toward the sell side. So we know we're going to be gearing up for a direct move. We just need to see the direction of that. And so the next daily candle prints like this. Now, very, very important details. Notice, right, that this is a bullish daily candle. That's the first thing. I want you to see here that we open down here, we wick below the low, and then we close toward the buy side of this daily candle, right? So we have a bullish daily candle that has wicked below the previous day's low and closed back inside of the range. Already that immediately tells me tomorrow is a bullish day. And on this candle, what we can see is that we open down here, we have a very bullish aggression, and we're closing toward the buy side. Again, above the previous day's high, closed toward the buy side. It tells me again that tomorrow is going to be a bullish day, or at least we are going to get a bullish expansion. Again, another bullish move. We've broken above that previous day's high and we've closed up in here. Again, that tells me that we're definitely going to be targeting this day's high, and we're going to be essentially ending up higher than the previous day's high. Okay, now what we see here is a bearish daily candle, right? But we were expecting higher prices. This daily candle right here, and if I just focus on just this daily candle, and let's say we drop down to a 1 hour time frame, right? Here we are, 1 hour time frame. In fact, let's go to a 15-minute real quick. So the day opens here, right? This is where the daily candle opens. It opens on and this is the daily candle. So this is the daily close to daily open. So it opens here. So you see that we actually open first going bullish. So the bias was higher prices. We got those higher prices and then eventually price sells off. And that's what that daily candle looks like. So if we go back to the daily time frame, what this now tells me is that tomorrow is going to be bearish because we've hit these highs, we've wicked above this high. So you're looking for a wick above and a close back inside bearish. That tells me that tomorrow is going to be bearish. But also, what do we have, right? This is step number 2 again. It's just reading your draw on liquidity. You can see here that we have this bullish fair value gap. So tomorrow then, I can already anticipate there's a good chance that we're going to trade bearish and we're going to enter in toward this fair value gap, right? That's what I have in mind. And again, I just want to predict the next daily candle. And again, what do you see? The next daily candle is another bearish candle, right? We've closed below and we've ended up inside of this level. Now, the key here is the power of 3, right? Many people, you've probably heard them talk about the power of 3. The power of 3 is essentially a manipulation and distribution, right? So you have, a range bound period like this, and then you have a manipulation, and then you have a distribution. That's kind of the power of 3. And it essentially states that before price will trade lower, it will first trade higher. You can see that time and time again in this model, right? So you can see here we've broken and closed below this low. But notice that beforehand, there's a good chance that we actually come higher and then lower. What I want to be is I want to be a seller at this level of price. So if we do the same thing again, if we square off this price action and we go to yesterday's open and close, so here's the fair value gap down here. If we remove this for now and we find the open of this day is here, 5 p.m. Eastern Standard Time. Notice that we're expecting bearish price, but before we get the sell-off, we get first a bullish move, right? That's the manipulation of the day and then the sell-off. So someone who wants to be a seller, I'm waiting for that manipulation and then I'm looking to sell after that manipulation occurs. It's always the same thing again. We'll always get the pullback and continuation. That's the same thing, right? It's like before you trade lower, if you have a bearish daily bias, the next day you're expecting, a manipulation before the continuation lower, and you want to basically be selling here. If this is the daily open, first we're going to manipulate toward the buy side, then we're going to sell off toward the sell side. And that is essentially what we're seeing. And so for me now, what I would be looking at for the next level is first and foremost, let's also talk about more draw on liquidity. What do we have here? Right, equal lows down here at these lows. Also, if you look down here, we have this overlapping fair value gap. Very, very interesting area, an area that I was talking to my students with for a couple of weeks, saying that ultimately we will probably end up trading into this level. Equal lows down here and an overlapping fair value gap. So we also have this as a draw on liquidity, right? Or a bias to trade towards. Again, looking at the next daily candle, what do you think is going to happen? For me, I'm indicating more likely that we're going to get more bearish price action, right? Another bearish continuation. What happens? We open, we first have a run toward the buy side, and then we have the sell-off. Doing what again? That same pattern, right? We have our open, manipulation, and move toward the sell side, right? And now what have we done? Now we've closed over that fair value gap. So we've inverted that fair value gap, which then also becomes another area of interest for me. So if I was to, let's say, be a seller now, right? An interesting move could be a retracement into here and then a continuation out of here. Right, this is how you're building daily bias essentially. Now notice what happens here. This time we actually have a bullish daily candle, and notice that we've wicked below this low and closed back inside. That to me is typically sign of a reversal, right? So what I would now be looking for is now we have this bullish fair value gap in here, which is also overlapping. Now I would be expecting the next day to trade higher above this previous day's high and into this level right here, right? Simple as that. That's what I'd be looking for. And what you notice is on this specific day, we actually don't get that. So we do get the open, we do get the manipulation, and we do start getting the momentum. So definitely you could have been in a trade at these lows. And again, if I open up the 15-minute time frame, which is my primary time frame for direction, you'll notice what? Market opens, we have the bearish manipulation, right? Even look at the structure on the 15-minute time frame. We were very bearish. Now we've shifted bullish, right? Which is yesterday's manipulation and close above the high. And now we're selling off. Again, longs accumulated in this New York session, and you're just holding them ready for the next day. We're probably going to end up in this level. So it's the same thing, right? Just because we haven't fulfilled the prophecy yet we've still been able to probably execute long positions in this area. And again, we go back to the daily, right? We've still anticipated bullish price action for that day after the manipulation, right? So anytime that I have a bias to go higher, I first want it to go lower before it goes higher, and I want to try to buy in this level. So this day, what would I be expecting? A continuation higher above these two highs. And that's what happens, right? We get that move. We open, we pull back, and we continue trading higher. Now what we've done is now we've come back into this bearish order block. You can use this level, you can use this candle regardless. And we've had quite an aggressive reaction from it. But notice we have actually closed above the previous day's high. So what this tells me is there is a lower level of conviction, meaning the next day is a day where it could go higher, but it also could go lower. So you keep those things in mind. But ultimately, it's a bullish candle. So you'd be expecting probably a continuation, right? Which is what we get. We get the open, low, high, close. So again, it's the same thing. Price is trading higher, but before it's trading higher, it's opening, coming down, and then trading higher, and then closing here, right? And so you're getting the open, low, high, close. That's what that is. So again, you're accumulating long positions in these levels based off of just the daily candle. Like, it's literally that simple. So for this day now, what we can see is we have a bullish candle, but we have wicked above this high and closed back inside of the range. This tells me that this could be a reversal, but it could also be a continuation. Again, there is a little bit less clarity on the situation. You're not going to get every single day absolutely correct. That's not the game of trading. The game of trading is probabilities. Hey, again, just give me 1 second. I want to quickly share something with you, which is an update since I've last produced this video, which is again going to help you even more. So what you're looking at right now is the data on what exactly you're watching, right? You're watching the daily bias. Now, I'm not someone who likes to just give ideas and things that look cool. No, I'm a data-driven trader. That's how you really actually get results in trading. So this is what I want to share with you. This, what you're looking at right now, it looks complicated, but it's really simple. This is for the both daily and weekly bias. So what I'm explaining to you, the concepts I'm explaining to you, we have gone and done a deep dive data collection with over 15 years of data. So looking at every single daily and weekly candle over the past 15 years, this is what we found. We found that the bullish bias is accurate on average 67% of the time. The bearish is accurate roughly 67% of the time as well. So the daily bias that I'm sharing with you right now over the past 15 years, right, which is 5,469 daily candles, it has been accurate 67% of the time. And we did the exact same thing for weekly, and weekly was actually slightly higher. It was actually 68% overall. So you can see bearish and bullish. So we are able to consistently predict the daily and weekly bias with a 68% degree of accuracy. And not only that, what I shared with you earlier on market structure, we've actually built into this same indicator. So you can see here, it shows us our market structure, but in the top right corner here, it actually also shows us the directional bias. So you can see here, it tells us that the weekly is bearish and the daily is actually bearish. So it tells us our directional bias. The directional bias is quite literally built into this indicator, as well as normal market structure, depending on what time it is that you're looking at. So yeah, I thought I would share that with you again. Just a gentle reminder, you can check it out. The link is in the description. So the next day, we get that continuation again, right? Higher prices, but notice that the momentum is starting to kind of fade away. So again, what do we get? A wick above the high and close back inside. So again, this for me now, when you're wicking above this high, closing inside the range, it's usually indication of a reversal, but you could also continue before you reverse, right? So a lot of the times when you get these types of candles where they're wick heavy, you'll probably see before a reversal, maybe a sweep of a high. If we look at this level, okay, so the next day, we don't get that. We get a very aggressive sell-off, right? So we close below that previous day's low. We open here, we manipulate toward the buy side. We have an aggressive sell-off. We close below the previous day's low. For me now, the next day is simple. We have equal lows down here. Again, that number 2, draw on liquidity, that bias. We have those equal lows as a draw on liquidity. We have these equal lows as a draw on liquidity. So what am I looking for today? This is a very obvious day. I'm expecting a pullback and then a sell-off, right? That's the daily bias. What happens? Again, we can go into the 15-minute time frame. You can see we open, we put in the high, and then we sell off aggressively, right? Perfect opportunity, perfect day to be getting into short positions, right? Where does the market open? Market opens here at 5 p.m. What happens? We pull back into this area, and then we sell off. In London session, we're good to be selling. New York session, sell continuation, right? Same thing, all based off of the previous day's candle. That's it, just the daily bias, right? So the market, we open, we put in the high, and then we sell off aggressively. So what do you think I'm expecting today? Well, now we've taken out this draw on liquidity, but we still have this one down here. We've closed below that low, right? Aggressive close below that low. And now I'm expecting what? A pullback and continuation again. What happens? Open, pullback, continuation, right? Perfect mitigation of this previous day's low. What do I expecting again? Well, now we've taken the draw on liquidity. We've hit the draw on liquidity, right? We've also hit into this fair value gap, but we have again closed below that low. And so I am most likely expecting lower prices for this day. And again, what do we get? We get open, pullback, sell off. So again, this is where you want to be looking at it. Before this day even opens, you're expecting, okay, today I'm going to be bearish. We're going to have a bullish pullback. I'm going to sell, go lower. Next day, bearish, bullish pullback. I'm going to be a seller, go lower. Next day, bearish, bullish pullback, I'm a seller, go lower, right? On this day now, notice that the momentum is starting to get a little bit slower. Now we're inside of our draw on liquidity. Now you can start adding that into the context of slowing down and expect that maybe at some point we'll start to get a reversal. But still, for this specific day, my next daily bias would still be bearish. Why? Because we've closed below the previous day's low. Again, what do we get? Open, pullback, sell off. Again, you're just a seller in this market. The next day, what am I expecting? Another sell. Now, notice that we do get the sell, right? So we do trade below this low, which was the goal of the day. But now notice what happens. We have a bullish day and we actually have a wick below previous day's low and a close back inside. This for me is literally a SOS that we are about to reverse. The market is going to now trade bullish. And it's very simple. Now you look and you see, okay, well, we actually have number one, point of interest that we're trading out of. Secondly, we have a bullish fair value gap here. We have a bullish fair value gap here, right? So now we have these higher time frame areas of interest or draws on liquidity that we're expecting price to trade back into. So now what do you think I'm looking for? Now, today, I'm expecting to be a buyer. Price is going to pull back in here and then shoot off up here. Pull back in here and shoot off in here, right? So what does the next day do? The next day, we open here, a very small pullback and a very aggressive bullish candle. Well, now what do you think I'm expecting price to do on this next day? Again, I'm expecting that we're going to have another bullish day, right? A little pullback and continuation. What happens? Market opens, we sell off and we go higher, right? 15-minute time frame. What does that look like? Again, perfect opportunity to get longs, right? The market opens here. Market opens, we sell off, London opens, right? There's a perfect entry opportunity in here. We traded long on this position. Market booms towards the upside, which is expected. So they get the manipulation, you wait for the manipulation, you wait for the confirmation on the lower time frames, and then you execute in long, right? It's so simple. It literally works every day. So now what do we have? We filled all of those levels. Now we have a bearish draw on liquidity, right? Because now we have this daily fair value gap. Notice that we have been accurate with a like 95% level of accuracy. Now this day is indecisive. We don't get a shift higher or we don't get a shift lower. That for me, again, is quite indecisive. I don't have a read on the next day. But then what happens? Then we get a bullish candle. Now we've wicked above this high and closed back inside. And we haven't closed above any candles. So that for me is usually a sign of a reversal, but because it's a bullish day, it could still trade higher before the reversal, right? And again, what do we have? Pretty much an undecided day. But we do have a bullish day and it has closed above this high and above this high. So I would be expecting for price on this day to trade into this old high, right? Very simple. And that's what we have. Open, pullback, trade into the high. Now we have a very bullish day. I would be expecting what? You answer this at home. Where do you think I'm expecting price to go? Higher, right? Yes. On this day, it doesn't happen. In fact, we failed to take out the high and now we have a bearish candle. So today, what I would be expecting is lower prices. We have a fair value gap here, right? We have a bullish fair value gap here, bullish fair value gap down here. I'd be expecting lower prices on this day. What happens? Market opens, pullback, sell off. We've closed below this low. What do you think I'm expecting the price is going to do today? Same thing again, bearish. Open, pullback, sell off. Perfectly into that old low. We close below. What do you think I'm expecting? Another bearish day, right? Pullback, sell off. Very aggressive. Where into? That draw on liquidity. Okay, fine. Another bearish day. Where do you think I'm expecting price to go? Lower again. Perfect. But then what happens? Now we do get lower prices. We could have been a seller, but now we have a clear reversal indication. We're coming from a point of interest. We've wicked below the low and we've clearly closed well above that previous day's low. Now I'm expecting a reversal. I'm expecting a bullish candle. What else do we have? we have bullish daily fair value gap. In this scenario, we get both, right? And that can happen. We get the run higher and we get the run lower. But for me, again, even still, a wick below the low and a close back inside, that's probably more indication of a bullish day for the next day. And we do have that bullish day next day. Now notice you go from expansion, a little bit range bound. So on this type of day, I don't have a clear, definite read on price. I'm just not sure. But what I do see here is we have created a swing low, right? We have one low, two lows, and a swing here. So this could be a protected low for now. And it is, right? Market opens, pullback, aggressive bullish shift. What do you think I'm expecting? Another bullish day, right? Open, pullback, higher prices. What do you think I'm expecting? Another bullish day. We do get the bullish day, right? Please understand, we do break this high, but now what happens? Now we've wicked above this high and closed back inside of this range. Tomorrow, I am expecting a bearish day. So we do get the bearish day, right? Price does sell off. This is the key thing. Just because it closed bullish, it sells off. But now it's sold off, it's wicked that low and closed bullish. Where do you think tomorrow is going to go? Tomorrow is probably going to be bullish, and I'm expecting this high and this high to get taken out. Again, perfect example. We pull back, right? And this is Monday the 1st of December now. So we've wicked, it's a bullish candle, but we've wicked above the high. I would be expecting a reversal. Now you come into, not into today, into the next day, right? Which is yesterday. So yesterday, you can see that we had a bullish candle. So we've closed above these highs. What do we also have? We have buy side liquidity. We have equal highs at this high. We have this old high, right? So what do you think I'm expecting? Coming into today, like as of recording this today, what do you think I'm expecting? I'm expecting price to take out this high. So now how did I trade this day? Let's take a look. This is price action right now. This is where we are. When I come into my London session for the day, my read on price for the day is bullish. Notice, guys, we have literally just gone through over a month's worth of price action, 6 weeks of price action, just using the understanding of the previous day's candle. And we have been accurate 95% of the time. Like, what I'm sharing isn't a joke. In today's price action, I'm expecting higher prices. So again, let's go back into London session where price opens up. This is what price looks like. This is the current daily candle. So we've opened here. We've opened and we're already trading bullish, which is what I'm expecting. But we haven't yet hit this old high, right, up in here. And we also haven't yet hit these old highs, which we just looked at on the daily time frame. And we know that that's going to be our target. So now what I need is step number 3, which is how do you actually become a buyer on these days? Well, what you do is you wait for a pullback. So you can enter into, let's say, the 1 minute time frame, right, inside of your session, or the 5 minute time frame, sorry, inside of your session, and you wait for a pullback, right, a manipulation internally, and then a confirmation. So you can see we move toward higher. We still haven't taken out those highs yet, right? These highs are still intact. That's equal highs. I'm first waiting for a manipulation before I trade long. That manipulation can look like that, right? Here it is. We're still expecting higher prices, right? The daily draw on liquidity is still higher. We've manipulated internal prices like this, and now notice we've gone from very bearish to kind of just sitting in this price range. We're just waiting for that confirmation, waiting for price to tell us that we can go higher. That's bearish candle. Okay, that could be a reversal. Okay, that's a manipulation. Boom. That's a bullish candle. So now in here, you can see that we're already getting the reversal, right? We were bearish and now we've shifted bullish. So now I believe that the rest of the day can then continue going bullish. And if we go to the 1 minute time frame, you will see that price was bearish, right? And now it's bullish. So now I've got my confirmation. The order flow has shifted. Now I can expect the rest of this day to be a bullish day, right? It's that simple. And where's my entry? Usually I'm executing entries on the 5 minute time frame. I'm looking at order blocks, fair value gaps, whatever makes sense, right? My entries are going to be in here on this bearish order block, bullish order block, sorry. My stop loss is going to be below the low, right? I can use this inverted candle here, whatever makes sense. And then I'm just targeting a 1 to 5 risk to reward. Let's say I have, 400K in one prop firm. I'm risking $4,000 on this one trade. I'm risking $4,000 to make $20,000. Right? That's the play of this. That's why you sometimes see me having these 30K, 40K days. So we get tagged into the trade. And now I'm just expecting the momentum of the day, right? The day's bias is just going to take me to my take profit. And that's it. That's why I wanted to record this video live in this moment. I think this is some of the most valuable things I've given out on YouTube. That is how we execute those trades. If you can master supply and demand, you'll be able to trade alongside smart money. Stop getting caught on the wrong side of the market and take loads of high risk reward trades with high levels of accuracy. In this video, I'm going to reveal to you the 5 truths about supply and demand that 99% of other traders will never understand, and that my students have collectively used to go on and make hundreds of thousands of dollars in verified trading profits. This video will tell you what is supply and demand, how to read institutional order flow, how to accurately draw your supply and demand zones, how to find high probability zones that actually work, and then finally, how to enter and exit trades for large profits. Okay, so first things first, I want to explain to you what is supply and demand and how it actually controls the price of everything. So in case you didn't know, supply and demand is literally pretty much what controls the price of absolutely everything that you can think of, all right? Bar maybe some luxury goods that are based on psychological scarcity. So let me explain to you supply and demand using this simple chart that we have right here, and also how it directly relates to trading. On the left here, we have price. Along the bottom, we have quantity. Every market that you trade, Forex, indices, crypto, whatever it may be, lives on this exact relationship. This downward line here, this line here is demand, and demand represents buyers. The higher that price goes, the fewer buyers are willing to buy. And the lower that price goes, the more buyers are willing to step in. This is why demand slopes downwards. This line here represents supply, and supply represents sellers. At low prices, sellers aren't interested. At higher prices, sellers are motivated. This is why supply slopes upwards. At this point in the middle, this is what we call fair value. This is the only price where buyers and sellers agree. In trading terms, this is balance. When price goes above fair value, sellers are happy, but buyers aren't. There's too much supply and not enough demand. So naturally, price wants to move down. When price trades far below fair value, buyers are excited, but sellers aren't. And therefore, there is too much demand and not enough supply. And so naturally, price wants to move up. And so you can visually represent this like this, right? Let's say we have a price chart. When price gets too far above perceived fair value, so when we go into this exploration phase after a range, essentially at this point in time, buyers aren't really interested. They're not really motivated to keep buying, but sellers are very interested and motivated to sell. So because supply outweighs demand, price naturally gravitates back to fair value. When we trade below fair value, typically what we see is that buyers are ultimately very motivated to buy in here, but sellers are less motivated to sell at these levels. And so naturally, price will start to gravitate more toward fair value. This is ultimately how a market is created, right? It's what a chart looks like. Behind the candlesticks that you see, there is a story that we are being told about supply and demand and its relation to price. This is literally the entire reason that a market moves. Price does not move randomly. It moves to correct imbalance and pauses at balance. That's again why you see price move in such a way where once it becomes imbalanced, price naturally wants to correct back to balance. And you know a balanced price range when you see a lot of price ranging around. When you see a range in price, usually this means that price is pretty balanced. Sellers and buyers are both pretty happy, and this is what we call fair value. The moment that price moves away aggressively like so, price becomes imbalanced, right? It's above fair value. And if you've ever seen a fair value gap, then essentially this is what we're referring to. A fair value gap is an indication of an imbalanced market. The market is always going from areas of balance to areas of imbalance. And its job is to find new balance at this level or to rebalance at old balanced levels. This is why the market always looks like this. As traders, it's not our job to predict the future. We are simply identifying where supply or demand is likely to overwhelm the other and positioning ourselves around those areas. That is literally it. Every strategy, every indicator, and every model that you've ever seen is built on this foundation. If you understand this, you understand markets. And from there, everything else is the smaller details and refinements that allow you to trade profitably consistently. And those are the details we're going to go into right now. So now we're going to be looking at institutional order flow, right? This is how a market actually works behind your candlesticks. So this is what the order book actually looks like. When you see a candlestick going up or a candlestick going down, beneath this candlestick is this, right? Which is what we call the depth of market or the order flow, whatever you want to refer to it as. In the order book, we have the bid, which is the buyers, and we have the ask, which is the sellers, right? Just think of it as if you are a bidder, you're bidding on something, you're buying that thing, or you're willing to buy that thing. If you're setting an ask price, you're the one that's selling for something. You are asking for this amount for the product that you have. So you already have the thing, and as a bidder, you don't have the thing, right? Very simple terms. When someone hits the bid, they are wanting to buy. When someone hits the ask, they are wanting to sell to a bidder. Obviously, for a market to work, every bid must have an ask and every ask must have a bid, right? That's how a market works. You cannot have a market where you have only the ask and no bid. So at any one point of time, we have two participants in the market. We have the aggressive and we have the passive. Passive liquidity looks like this. So the current price is 1.5. Let's just say this is the current price. Let's say you were an aggressive buyer, and let's say price was 1.5 right now. If you were an aggressive buyer, you would essentially have to go and find the most readily available seller. And so you would have to go and meet a seller of this, which is the ask. So if you were an aggressive bid, you would go and bid on the most recent ask, which in this case, let's say it's 1.6. So let's say we have a passive seller, right, who is sitting at 1.6, and at 1.6, let's say they have 7 lots available. And let's say there's another passive seller at 1.7 who has 3 lots available, right? So if you were an aggressive buyer, price is at 1.5, and you want to hit the bid for 10 lots, here's what would happen. You would get filled your first 7 lots at 1.6, right? And then these 7 lots in here become 0. Then your next lot of liquidity, which is the 3 lots that are remaining, would get triggered at 1.7, right? And then this would get cleared and this would be left at 0. And now the current price would be at 1.7, which is like this, right? This is how you see a candle. You have the open of the candle and you have the current high of the candle. Now let's say the bid starts filling back up with more passive buyers. So you was the passive buyer at 1.3. You see that price is increasing. Now maybe you change your mind, for example. Now let's say you're like, oh crap, I'm probably not going to get my order filled at this price point. Let me add my passive order. Let's go to 1.5. And so now let's say you place your order again at 1.5. You would be now sitting here in the order book. Now let's say, for example, we get an aggressive seller step into the market at 1.7. And let's say this aggressive seller has 15 lots that it wants to transact. So that seller will transact those 15 lots to the most recent bids, right? The passive liquidity that sits in the bids. And so where would that be? Well, we're at 1.7. Let's say there was 0 lots available at 1.7. Price would skip from 1.7 down to 1.6. Let's say there's no liquidity at 1.6. Price would skip back down to 1.5, right? And then you would see a wick form. Notice that there's a wick at price. This represents the highest level that price has been at. Now we have that wick form. And so you're available at 1.5, right? For 10 lots. So now your 10 lots get triggered. You get filled at your price that you wanted to get filled at, and price continues going lower to the next available liquidity. Let's say it's at 1.4, and let's say there are 5 lots available. Price would travel like so down to this 1.4 level. This candle would then become a bearish candle with a wick on the buy side. That's how a candle is formed. Now we're at 1.4, right? Which is where the aggressive seller got their entire position filled at. So they wanted to sell at 1.7 and their entire order was filled, and the filling of that order was finished at 1.4, right? Giving them somewhere in the average fill value of around 155, something along those lines. That is essentially what we experience when we get slippage. You get slipped when there isn't the available liquidity for you at your specific point, right? That's why we experience slippage. And this is how a market is made. That's how a candlestick is formed. That's how a candle goes up and down, up and down. Now, on a lower time frame, let's say, for example, this was the daily candle that was forming. On a lower time frame, what's actually happening is price started at 1.5, right? And then it made its way up to 1.7, and then it traded its way back down to 1.4. And so on a daily time frame, you just get this one candle building out. But on a lower time frame, what we're seeing is what we've just gone through on a massive scale. So instead of it just being me and a couple of others bidding, we're talking about thousands, if not millions, of different transactions coming in. And so now you can see how this becomes complicated between the supply and demand, and also how we see all of these small little ticks in price every second. That's because what is going on in this very simplified explanation that I've just walked you through is going on a massive scale deep inside of the order book, right? With millions of market participants. And so that is how a candlestick is formed. And that is also how one candlestick is formed. If you zoom into that candlestick, you will see on the lower time frames, you'll see an entire narrative of price performing with structure and highs and lows and all this sort of stuff. That is how price moves. And all of this is simply the supply and the demand. The supply is the ask and the demand is the bid. And there are two different types. There is aggressive and there is passive. The aggressors attack the ask. If you're an aggressive buyer, you attack the ask. You don't wait for price to come to you, you go to price and you're willing to buy at that price right now. If you're a passive buyer, you're sitting and waiting for price to come to you, and vice versa. If you are an aggressive seller, right, you're attacking the bid. You're going to find the most recent buyer. You're showing up to him and you're presenting your offer to him. If you're a passive seller, you're waiting for the buyer to come and find you. And if they don't find you, no problem. I don't get filled on my position. If they do find me, I do, right? That is the difference. And the price the aggressive participants have to pay is usually some form of slippage, or could be some form of slippage. Okay, so if all of that was maybe a little bit confusing, hang in there with me because I'm about to simplify it so much more. So now we're going to walk through how to identify institutional levels of supply and demand in a simple price action chart. So it's very simple. What we just explained is that price is always going from balance to out of balance. So how to identify supply and demand is very simple. In this instance, we can see that price is trading higher, which means that demand is in control. Now, all you need to identify a range in price followed by an aggressive expansion. This will give you a demand zone, because what we can see here is that this range in price, as we've already explained, there is a relative equal level of supply and demand at this level. The reason that price is ranging so well is because buyers and sellers are agreeing on price at this level, and a lot of transactions are able to take place. This is an area of balance, right? When price is like this is usually an area of balance. And then what happens? Out of nowhere, price aggressively runs into one direction, completely moving out of balance and into expansion. In this instance, that expansion is bullish. So price is trading higher, which simply means there is more demand than there is supply. That is why price is continuously moving higher. Price is going to try to find sellers, right? There is an abundance of buy liquidity that is available in the market. Price needs to go and balance that buy liquidity with sell side liquidity. And so price is hunting for sellers to fill their orders out. That is why we move out of balance into imbalance. Now what we do is we take the trading range in here that we were gravitating towards. We take the trading range that we were gravitating inside of. This was the previous area of fair balance. This area now becomes a demand zone, right? Why? Because demand originated from here. This is where the area of demand originated from. And I'll tell you a little something. When you understand institutions, large level players, these are institutions that are trading with so much capital that it's very difficult for them to fill their orders. What I mean by that is we just explained how the market works. So if you was a institution and let's say you had, 10,000 lots that you needed to trade and you had a target for those 10,000 lots. You can't just go to the market and dump your 10,000 lots into the market and buy 10,000 lots of $1. Why? Because of your 10,000 lots, you'll probably get some here, 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 some here. Because it's such a large volume, you will end up taking the market from down here to up here for you to trade this 10,000 lots. Because for you to buy 10,000 lots, you need to find 10,000 lots in supply. And there may not be 10,000 lots in supply right here. There may be 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here, 1,000 here. So if you deploy it all right now, the price is just going to explode because it's just going to keep running up on the ask side to say, hey, who's got lots for me? Essentially, it's going into discovery phase. Who's got the lots for me? I need to fill my trade. And this trader then, who's trading these 10,000 lots inside of this institution, gets a very bad fill. Let's say they wanted to fill, they have a target. They get into the markets in the morning, they say, hey, today my objective is to fill 10,000 lots at 1 EU, right? €1. And if they just dump all their order in at 1, they'll probably get their average order value at, let's say, for example, 1.5. That's a terrible job. So they didn't hit their target of getting filled at 1, they got filled at 1.5 because they dumped all their liquidity in now. Instead, what these institutions will do, they will find an area of balance where price is accepting. And what they will do is they will slowly sneak their orders into this area of balance. They'll place 1,000 in here, wait a little bit, price finds balance, 1,000 in here, price shoots up, it's respected, we find more balance, they'll put 1,000 in. And so they load up in these areas. This is the load up phase for a large institution to fill a large order. That's the only way that they're going to get all of their order filled at the price they want it to be filled at. And then once their order is filled at that level, that is when their job is complete. And so in these areas of ranges, this is where you will see institutions build up on price. And then let's say that trader was on the right train, right? Price then extrapolates into this direction. It expands into this bullish direction. Now this area of price holds a level of demand because there is a lot of demand for price at this level, right? As clearly seen. And the fact that price aggressively expands so high insinuates that all of the demand was not filled at the best available price. So let's say in another scenario, this same trader with the same goal of filling 10,000 lots at this level, which is what happens most of the time, they get that target and price is in balance. And whilst price is inside of this balance, maybe he only gets to expand 6,500 lots. And then all of a sudden, because he was buying so much, there wasn't any sell liquidity at this level anymore. Sellers become exhausted. There's no one willing to sell this level anymore. And so price goes into search for sellers. That trader is not happy about trying to fill the rest of his order in this price leg. So what he does is he waits and he sets himself as a passive buyer at this same price point for his remaining 3,500 lots. What happens? Price goes outside of the balance range. Price usually gravitates back toward the balance range. And when price hits this level, guess who is there waiting? Mr. 10,000 lots is still not triggered his whole order. So when price comes back in and sellers are moving through the price, there is just this large 3,500 lot order holding this price until eventually the sellers who were trying to push price lower and sell at these levels get exhausted. Once they get exhausted, the sell side of the order book becomes thin and buyers instinctively just push price higher. And that just happens as an automatic process. That is why these demand zones, when you find the correct ones, they hold. And you will know it's an institutional level of supply and demand if you see these large ranges and then massive expansions out of that level. That is how you actually identify an area of institutional supply and demand. Now let me show you this in a real example. Okay, let's take this price chart here. What do we see that has happened right here? I will tell you very simply, what we see is that price was in a range of balance, and then price boomed up into here, moving price out of balance. It's as simple as that. We had fair value and we moved out of fair value. Who is dominating in this transaction? Obviously buyers, right? Demand outweighs supply. That's why price has gone and traded higher, right? So then this level in here would be your demand level, right? And this is how I would draw it. This in here would be your area of demand. And so you can draw this across here and notice that price goes from searching, failing to find new accepted balance, and it comes back into this area of demand. And then what happens at this level? Here is our demand, here is our expansion out, price comes back to this level, right? Sellers are trying to attack this level, failure to do so, and then price has the continuation expansion from this area of price. This area of price is very clearly and obviously an institutional area of demand. Okay, now what I'm going to show you is how to identify high probability supply and demand. Simply put, supply and demand zones are everywhere in the market. How can we truly understand which ones have a higher chance of working than others? And the way that I have found through years of the data that I have gathered on this specific concept, I found one thing stands out above all else about how to truly understand whether a supply and demand zone will actually work. And that is structure, institutional order flow, right? The actual market structure of price. And so notice in this price level here, what do we have? Price starts up here, right? Price comes down. We have a low. There's a low in price. Price puts in a lower high. This high is lower than the previous high. That's already a bearish indication. Price then puts in a lower low. This low is lower than the previous low. At this point in time, it is very clear and obvious that price is bearish. So the overall flow of orders are bearish. So we have a lower low, price comes in again, price puts in a lower high. Or in fact, price doesn't put in a lower high, price liquidates the high. That's an even clearer sign for me. When price takes out an old high, but with a wick, and we then close down here, that to me is a massive indication of market reversal. So we have bearish trend plus a market reversal indication. And then we have another take of the low. So when I'm coming into the market each day, I want to understand just the simple current trend. So we have a swing high and we have a swing low down here. Now I find that the best way to do things, right? Let's say I play price out like this. What you'll notice here, there is both a demand zone and a supply zone, right? Very clearly. How do I know that? Well, you can see that price was in a very tight range in here and then had a very aggressive sell-off. So this is going to be our supply zone. You can just take a low to a high inside that range and pull that across. That's going to be a supply zone. Then at the bottom of this supply zone, price finds another range. We'll take the low to the high of the range, and then we have aggressive buy out of that level. So we have demand in here and we have supply in here. And so let's say the supply trader has their levels in here and they want to take out this low. And let's say the demand trader has their levels in here and wants to take out the sellers, right? This person's betting on demand. This person is betting on supply. Now, the higher probability of who is going to win this battle is the one who is trading with the trend, right? Very simply put. So the trend here is bearish. So therefore, the higher probability is that the supply level is the one that holds and the demand level is the one that gets traded through. Now, this demand might hold momentarily, but eventually this demand zone will lose. And that's what we see happen in this example. We see that the supply zone is reached. On multiple occasions, this supply zone gets reached. We reach in, buyers try to attack it again, and both of the times they fail. Now we find ourselves approaching this demand level. Demand reacts and immediately trades straight through it. And so if we remove both of these, we will see that the supply that's in alignment with the trend will always outweigh the demand that is against the trend. Here's another example that happens shortly after. What we can see here is that price is very clearly bullish, right? We have a break of structure across here. And so we have our swing low and our swing high. Notice that price in general in this area is in pretty much a balanced price range. At some point in time, price becomes out of balance, right? We've gone from the range of this level to out of this level. What you'll notice is that there's this massive range and the expansion. And so you can literally take, right, whatever of this range you would like to take. You can take this entire level if you would like to. This is going to be your demand zone. And again, very clearly, if you are a buyer of this demand zone, and simply just taking out the highs. Again, obviously I do not trade with a 1-to-1 risk reward ratio. It's just the purpose of showing you. You'll notice that price comes straight into our demand zone and then straight out of the demand zone. Notice that again, even this in of itself, right? Price has had this long range for a while and now it's expanded out above this highs. Even this entire zone in general, this is an institutional level of demand. And so it's expected that this level will probably hold itself and continue trading higher from this specific level. Right? And that's ultimately what happens, because this entire level in here really acts as a demand range that builds up, we expand out, we come back in, we build up, we expand out. Okay, now we'll put everything together and walk through how we will actually enter and exit using everything that we have just learned here in this video. So before we actually even identify supply and demand, as we explained, how to identify high probability supply and demand is based actually on the market structure. So the first thing that you must do when you come into the market is identify your current trend. And so I like to use the 15-minute time frame on Euro US dollar. And so what we can see is that price was actually very bullish, right? We see that price puts in a high, a low, higher lows, right? It's putting in consistently higher prices until eventually we have a high in here that puts in a low down here, that puts in a new high up here, right? So this is a bullish break of structure. At this point, price was very bullish. And then price breaks those lows down here and we actually shift bearish. So we were bullish and now we're actually bearish. The high in here and the low down here. So first things first, we take out this and we're going to put our low in here and our high in here. Now, to me, nothing matters other than me being a seller of this market. And how I want to do that is first identify the trend, which we've just done. Second, then identify the area of supply. And for me in this instance, the supply is obvious, right? What do we have? We have a very range-bound price before aggressive expansion. So we have everything we just looked for, our range and then expansion. So inside of our range is our institutional area of supply. But I'm not going to just try to take this level, right? Because I would be basically trading this, my stop loss here and my execution up in here, right? That's not really what I'm looking for. 1 to 1.57 risk to reward. That's not what I want. I don't want to risk $1,000 to make $1,570. No way. So what I do is I mark out these zones like this, right? I will just mark out this as a supply zone, right? Very easy area of supply. And I will just wait for price to get into that zone. So here you can see that price gets into my zone. And instead of just trading from this level, right, which is what we just looked at, instead of just taking this trade, which is very low risk to reward, what I will do is I will wait for confirmation. And so I will go to a 1-minute time frame and I'll look at the market structure on the 1-minute time frame. Notice that as price makes its way up to this gray box, which is our supply, notice that the 1-minute time frame is very bullish, right? And so what I wait for is I wait for a shift. I wait for price to tell me that this area of price is confirmed. And so price is bullish, right? And then eventually when price shifts, that would be my confirmation. And at this point, that's when I can be a confirmed seller of price. And so now I need to find my level. And my level is very simple. I'll go to a 5-minute time frame and I will just use this specific order block, right? This final buy to sell, because this is the area that everything changed. This is the area that price went from demand in control to supply in control. And I want to find the last level of demand that was in control and where the supply came in. And that's what I want to use. I want to use this level as my entry point, right? And so that becomes my entry, just like this. And I'm pretty sure, yeah, price doesn't even hit it. So I wouldn't even go into the trade. And so this tells me that the order flow has shifted. Because remember the order book that we showed earlier, what we're seeing here is that demand is consistently taking control, right? Price is just going higher and higher and higher in the order book until sellers take control, right? Which is this high here. And then all I need to really do is just find the area. You can literally just use the entire range. I can take the low to the high of this level like this, draw this across, and I can use that as my entry point. That can be my entry, right? There's no problem. That's a 5 pip stop loss. And so now notice the difference. Nothing changes. I'm taking the same target, right? And pretty much all of my trades are 1 to 5 risk reward. And so nothing's changed. It's the exact same idea, right? We are bearish. This is our area of supply. But instead of taking this trade, where I would just open the trade here and put my stop loss up here and take out this low for a 1-to-1, I'm waiting for confirmation. So this makes my supply and demand even higher probability, because I'm not just taking it, I'm waiting for price to come in and clearly reject this level. You can see we come in bullish and now we're shifting bearish. You can see the clear rejection. Once we get the clear rejection, then I take my entry and I just do the same thing that I would in this one. But instead of getting in here, stops here, I get in here and stops here. It's a much more refined area of price. And we can see how that plays out by looking at the 5-minute time frame. It's a beautiful entry in. Price starts moving away. Even in here as well, notice what's happening, right? This supply and demand is existing everywhere. Price sells off, price finds a new level of acceptance, right? Price ranges and then expands. Every time frame this is occurring. What happens? Price expands out, price comes back into this supply, and price starts moving away once again. And eventually we'll run through, and this supply zone holds the entire time. And that would be your trade idea complete. Order block is essentially an area of price where there are large resting orders waiting to be triggered. And so when you see price trade into these areas, into these order blocks, you will be expecting to have some reaction out of that order block. Now, the key is in selecting the correct order blocks. Okay, so how do we actually identify an order block? Here's what you want to be looking for. Essentially, you want to find, number one, the first thing is, where do you see a large amount of volume kick into the market? Essentially, that can be identified as a very aggressive candle either in one direction or the other. So for this example of identifying a bullish order block, we can see that we have this aggressive bullish candle that moves to the upside. From there on out, what you want to be identifying is this final candle just before that impulsive move, right? We call this the sell to buy candle. This is what is going to be characterized as your order block. It's essentially the area of price that first sells into the buy, and then we have the aggressive move out of it. Now, to identify this, your order block should always have a fair value gap, ultimately an area of imbalance. What we can see here is this first candle right here, followed by the second impulsive bullish candle right here, and then we have one more bearish candle. Now, the key here is to notice that the first candle, that wick, the highest wick of the first candle right in here, does not meet with the third wick, right? So we have one candle, two candles, three candles. This wick does not meet this wick, and that leaves a gap, right? A fair value gap. If you can notice a fair value gap, then the likelihood is there is an order block somewhere around that level. And how you identify that is you just want to use the final down candle before that up candle in a bullish order block scenario. Or what you can do is, if you want to identify a bearish order block, essentially what you want to be looking for is the final buy before you have the aggressive sell candle. But remember, the candles of the first and third must not meet. In this scenario right here, you can see very clearly that this first candle and this candle right here, they both touch each other. Therefore, that does not give you a fair value gap. Therefore, that does not give you a bearish order block. So we can just continue playing the price out. What you will notice is we have a buy candle in here, right? And then we have a sell candle, then we have another sell candle, and then we have a third sell candle. Now, again, we want to be identifying this candle right here and this candle right here. That is essentially your fair value gap. And wherever there is a fair value gap, there is going to be an order block in there somewhere. And so how we want to identify that is just looking at the final buy to sell candle that forms just before that aggressive momentum. And what you can do is you can use the bottom wick of this and the top wick of this, and that will create your bearish order block. Okay, so here are my 3 rules that I go to when I'm trying to mark out high probability order blocks. So rule number 1, and arguably the most important rule, is you must be pro trend. Time and time again, traders are trying to trade bearish order blocks when the order flow is bullish. It makes no sense. So make sure that you have this external swing structure aligned like this, and you can see that price makes low, high, higher low, meaning this low here is higher than the previous low, and then we have a higher high. So at that point, it's already indicated that price is bullish. We have this bullish breakup structure like so, and then price is going to respect this area in here, and I can guarantee you there is some type of order block inside of here that price then is able to react from. So that is number 1. Make sure you are pro trend. Number 2 is you want to wait for some sort of run on liquidity from that sell to buy level. So what we can see here is we have this bullish structure, and then as price pulls back, you can see it puts these internal lows in. Now notice that this final sell right here, this final sell to buy, actually causes a run on liquidity. So we actually run on the lows in here, right? So we have a liquidation in here. So you want to see a run on some sort of liquidity before that order block is formed. And then don't forget, make sure that this order block, this sell to buy, has a fair value gap from candle 1 to candle 3. There's your fair value gap. Great. Now you know how to identify your order block. Now, final one, and my golden rule number 3, is make sure that that order block was something that led to a break of structure. That order block itself doesn't have to break structure, but there has to be a break of structure in that price leg. For example, what we see right here is now we are bullish, right? We have our swing low down here, and we have our swing high up in this region. So as long as we stay inside of that price leg, this order block is valid. But if we do something like this, for example, let's say we now pulled back like this, and then we went and did higher high and we had a new break of structure, well, this order block no longer becomes valid. What we'd actually be then looking at is probably some sort of sell to buy inside of this price leg in here that leads to a break of structure. So make sure that the break of structure has a order block inside of. Make sure the order block you're looking for has a break of structure inside of it. So from there, there's the 3 rules on how to identify the order block. And if you have something like this, where you have a pro trend move, right? We have higher highs, higher lows, higher highs. Price pulls back, gives a run on liquidity, this bearish sell to then buy, gives the engulfing candle, and then breaks some sort of structure. That is a high probability area for price to then be able to come back to something like this before putting in some sort of high high, and this is exactly where you would trade from. So let's take a look at what this order block scenario looks like in the markets themselves. Here we are, and what we can see right here is the price is bullish. So step number 1 is, where is your directional bias? You can see we had this low in here, puts in a high, price pulls back, right? Respects what? Respects the previous bullish order block that we were talking about. And then what does price do? Price then has this aggressive move out of this price range, breaks structure, right? We have a break of structure to the upside like this. So there we have our pro trend. We're trading with the trend. We have our break of structure that was come from this bullish order block in here. And then finally, what else do we have? We have our run on liquidity, right? You can very clearly see that we have an old low in here. Then we have this final sell into this liquidity, relative equal lows, sell into liquidity, and then aggressive buy out. So we've ticked all 3 boxes. We're pro trend, right? We're clearly in a bullish trend. We have taken a run on liquidity, and then we've broken structure. So that means that our order block is inside of the structural price leg that we're currently trading inside of, our current trading range. Then what you can do is you can map out your area of order block, your bullish order block, and then you can just wait and see how price reacts. So you can see price has a reaction, a bullish reaction, drops down deeper to mitigate, and then begins aggressively advancing out of that level and takes out the continuation, right? Another break of structure, just continuing in the overall trend that price is currently trading in. Now we're going to take everything that we've just learned about the basics of order blocks, and we're going to apply that into my step-by-step profitable order block trading strategy. I'm going to give you an exact rundown of a trade that I took using the exact strategy that I'm going to be sharing with you. Okay, so now let's walk through this trade on Euro US dollar during London session. So first thing I'm going to do is I'm going to switch on my session indicator. This allows me to outline the exact sessions, so you know that this is during the London session. Now, step number one is we need to identify what is the trend direction. And so you can very clearly see that price was aggressively bearish. We put in a lower low, a lower high, a lower low, giving us a break of structure to the downside, followed then by a change of character. So you can see we've changed the trend here. We were indeed bearish, putting in a series of lower lows, and then we've put in a higher high, meaning this high that we've just placed in here is higher than the previous high. Therefore, we have now shifted bullish. So we no longer want to be looking at any bearish order blocks, anything of that nature. We want to be paying attention to the present moment trend, right? So we want to make sure that we are trading inside of this trading range. So our bias is indeed bullish. We are looking to take long positions. Now, step number two is I need to find an order block that makes sense to trade from, right? And this is going to be my point of interest, my higher time frame point of interest, right? So what we're going to be looking at is this particular session in here. This is Asia. In this blue box from here, it's from 8 till midnight EST. This represents the Asia session range. Now, as you guys know, the highs and the lows of this Asia session range are extremely liquid. So what we want to see is coming into our London session, we want to have a clear directional bias, which I have. I am bullish. I want to have a clear point of interest below Asia session low. If I'm buying, I want to be buying below that Asia session low, right? So where in here can you see that we have a clear area of order block? Well, you can see very clearly in here, right? This final sell to buy candle that has a fair value gap. You can see the first candle in here does not meet with the third candle in here. That is our clear and obvious fair value gap. You can see that it runs an area of liquidity, right? So the final sell runs the previous candle's low, which is a run of liquidity. And then we have this aggressive push out. It's inside of the area. It's inside of the pro trend move, right? We've already had our break of structure. This order block is inside of that break of structure price leg. And what we want to see is price pull back, liquidate Asia low, drop into here. And then when I get into this area, I don't want to just take a risk entry on here, right? And besides, even if I was to take an entry on here and target our target, which is our Asia session high, that's going to give me 3.3 risk reward, which might seem decent to a lot of you guys, but some of you who know and have been around here for a long time, you know that my minimum risk to reward is 1 to 5, right? So what I want to do is I want to get into this area, then I want to drop down to the 1 minute time frame, and then I want to take my entry there. So let's see how that plays out. First thing is waiting for price to get into this area. And there is the objective complete, right? We have equal lows in here. We have Asia low in here, which is a prime area for a sweep on liquidity. We've now run the liquidity. We have our point of interest. We are pro trend looking for buys. Time for our entry confirmation. So what we're going to do is we're going to drop down to the 1 minute time frame. And now we need to establish what is our directional trend at the moment. So you can quite clearly see that we are bearish, right? We're in this heavy downtrend. And we can see that this was our swing low. Price pulled up, swing high. Then we went lower low, right? Lower low, lower high. And what you can just notice, price has just what? run on liquidity. This low that was supporting this bullish move up has now been liquidated. So what we would need to see is a realignment, a market structure shift above this high, displacing this high, and then that would be our confirmation the 1 minute time frame is now ready to go in the same direction as that 30-minute time frame. So if we just play price out, there is your displacement, right? There's your market structure shift and your displacement. Price was putting in a series of lower lows, lower highs, liquidation of the low, run of the high, giving us a realignment, displacing above the previous high. And now what do we want to see? We want to see an area of demand. We want to see a bullish order block. So what do we need to see? Well, we need to see this move right here, this sell to buy that breaks structure, that's coming from our higher time frame point of interest, that has taken an area of liquidity, right? Any low or any high in an opposite example is a run of liquidity. But not only is this a run of liquidity, this down here is also a key run on liquidity. So we had a run on liquidity here, price pushes up, reacts to this bearish order block, pushes down, and then buyers outweigh the market, giving us a sell that liquidates price and then break structure to the upside. Now we just want to look at this as our bullish order block. You can see it has fair value gap, candle 1, candle 3 doesn't meet, we have a fair value gap. That is where we want to look at taking our position from. We want to put our stop loss below this low in here. And I know what you're thinking, that is a pretty tight stop loss. And it is. So let's continue and see where are we going to take this trade to. Well, we want to always be trading in alignment with the trend. So if we know that we're bullish, we want to just take price to the next logical high that makes sense. So we want to go for a minimum of 1 to 5, right? So there's our 1 to 5. There is our displacement. Now it's time to enter. And this is where we're going to be entering from. So price continues trading higher. Price ranges. Okay, price is now at this point creating what? Creating a range. What do we understand about ranges in price? A range in price is creating liquidity on both sides of the market. So when you see a range occur like this, that is ultimately building liquidity on the buy side and on the sell side. And what you'll see a lot of times happen is you'll see a run first on the buy side liquidity, inducing all of these buyers. Everybody is now looking to buy because everybody's perceiving this as a breakout. And then price runs the actual liquidity that it wants to run and then goes into the direction that it really wants to trade into. So pay attention for that schematic right there when we break this down, right? What do we see? We have equal highs across here. Okay. Price runs the equal highs. What do we have across here? We have relatively equal lows. So price has now run the buy side of the liquidity. Okay. Now it's created what? More equal lows across here, stacked lows, equal lows here, lows here. Again, running buy side liquidity. So this trade becomes invalid if we break this high. If we hit the take profit before we have been tagged in, obviously this trade then becomes obsolete. There's no need to take it anymore. However, if it doesn't, then we still trade it as is. So there you can see there is the aggressive liquidation of this low in here. There's your liquidation. So at this point, price may or may not tag you in. Again, just keeping the order open. So price does tag in, and if for whatever reason you would have removed your order, then you can pay attention to the details by reconfirming this area of price. Because what do we notice in here? Well, you can see as price pushes up, right, and then breaks structure, these tiny little swing points are dictating the order flow. And so you can see that price is printing this lower internal trend, right? Even again, you can see it's printing this lower internal trend. We have low, high, lower low, lower high, lower low, lower high, liquidation. And then what do we have? It's the exact same thing over and over and over again, right? So we have had no break of structure yet. So we would need to see some sort of break of structure. But there, when you have your break of structure, what do you now have, right? Again, price, I'm going to zoom in to pay attention to detail, right? Again, these are the little details that people overlook. What do we see? We see that price is printing lower lows, lower highs, lower lows, lower highs, lower lows, liquidation, higher high, right? There is our order block, our bullish order block that breaks structure. Number one, it breaks structure, it liquidates, and it's aligned with the overall trend. So if for whatever reason you wasn't able to capitalize on the original move, you can put another position in. I would cover the same stop, right? So stops on this same low in here, just in case it does want to come a little bit deeper. And then where do you target? You're just looking at the exact same area because the bias is to take price into this area. So that's a 1 to 6.85, and then keep playing price out. So price aggressively moves out of this level, and then eventually price runs to full take profit with two potential profitable positions, one for 1 to 5 risk to reward and 1 to 6.85 risk to reward. The first winning order block is what I call the sweep shift. It's very, very simple to understand. Essentially, imagine you have price action that's trending in an upward direction. So we have a swing low down here, swing high, swing low, higher high, higher low, higher high. So we're bullish. And then we change character. We shift from bullish to bearish. Well, in this process, what you want to look for is the area of price where we sweep this old high here and then aggressively shift below this low down here. If you can find an order block at the height of this price leg, that is a high quality order block. From there, you can essentially expect price to have some kind of retracement into your order block, and there's a likelihood that this order block will hold, and you can trade from this order block and essentially just target the next weak swing low. So as you can see, we have a swing high up here. We put in a low, and then we put in a new higher high. Now we're coming for a pullback, right? It's over 3 candles, so it meets my criteria. Then you can see we break this high. So my current swing structure, this is my swing low, and we are still bullish, right? Note that this is Asia session high, so it's a highly liquid area of price. Then what we can see is that we aggressively break below this low. So what we have is a break of structure on the buy side, followed by a bearish change of character on the sell side. Then, as you can see, you want to identify the last area that caused the sweep and the shift. And in this instance is this final buy candle before the sell-off. This right here would be my order block of choice, and an order block that I have consistently seen to work. And then essentially you can literally just place your entry off this order block level, and all you have to do is just target the next swing low. And this has a very high success rate. Now let's break down winning order block number 2. And this is what I call the continuation trap. Very simple model again. What you can see here is we have bearish price delivery. So we have a high, we have a lower high, and a lower low, and then we shift bullish. So now at this point in time, my swing low is down here and my swing high is up here. But what you can see is as price starts to pull back into this area, we have some bearish internal structure, right? Internal low, internal lower high, lower low, lower high, and then lower low. At some point in time, if price is expected to trade above the high up here, which it is, then we need to wait for an internal change of character. That's the shift from bearish internal to bullish internal. When you get that, now what you need to see is a buildup of liquidity, right? Preferably some kind of Asia session, which you have seen by now I use a lot. If we have some formation of liquidity at an Asia session low and the order block that broke structure toward the buy side is below that level, it's a very, very good order block to trade from. Same thing again, you can just place your entry in here and you can literally target the next swing high in structure. And so here we're able to break down what that looks like. Again, remember where we've just came from, we were bearish, right? We're putting in lower lows, lower highs, lower lows. And then eventually, as you can see, we shifted to become bullish, right? So we have a swing low that is down here and we have a swing high that is up here. So as of right now, we're bullish. However, what happens is when price puts in this new high, we have a low, lower high, lower low. So we're internally bearish until eventually we shift this high internally and we break that structure. From here, what we can expect is that this high now is going to be traded through. And again, we can see that if this was our swing low and this was our swing high, where's the order block that caused this change of character? That is very simply this final sell to buy in this area. And guess what? It is also just below this Asia session low, which is a massive piece of liquidity. And it's the same thing again. You can literally just place your long position in here, put your stops below this level, and then you can target straight away this old swing high. And again, this is something that has consistently played out time and time again. Now that we understand order blocks a little bit better and how to identify ones that work, now I want to show you how to actually double your risk to reward ratio with one simple thing. So let's take a look at this. 30-minute time frame, we are obviously trending bearish. Our swing high is up here like this. We've had a break of structure. Right, our swing low is down here. It's very simple price action. So we know that this low down here is our actual target. We know that this is our protected high. We know that this is a good order block because it has taken previous New York session high plus previous London session high. So this area has taken a good level of liquidity. It has had an aggressive expansion to the sell side and given us a bearish break of structure. So we know then that this is a good order block. However, we don't want to just place our order on this level. I mean, you can in theory, but if we were to do this, let's say our swing low target would be just a little under a 1 to 3 risk to reward ratio. It's not terrible, but you need a much higher hit rate. So what I like to do is instead of just taking a trade from this level, I actually want to wait for price to come into this level. And when we get there, I want to drop down to the 1 minute time frame and I want to tune in to what's actually happening in this level. You see, not only am I going to double or even sometimes triple my risk to reward ratio, but I'm also going to add an extra level of confirmation on this order block to make sure that I've actually chosen the right order block. So this one thing alone has made me a ridiculous amount of money. You see, as price approaches this level, the 1 minute time frame tells a story. And that story is that right now, buyers are in control of this market. They are dominating the price and they are pushing price higher. So if I want to sell, which I do, it's a little bit premature to sell right now because instead of just having my order on here and my stop loss on here, I can essentially wait and refine my risk to reward ratio, the area that I get into the market. And how I can do that is by waiting for confirmation. Instead of trying to just short now when price could very easily just continue trading higher, and we don't know that this order block is guaranteed to hold. We just know it's got a good probability. Sometimes they don't. What I want to do is wait for that true confirmation with a market reversal. So price is bullish. As you can see, I need to simply just wait for price to become bearish like this, right? What we can see now is that we have actually broken this low. So we had a swing high, swing low, higher high, lower low. So now we're bearish. However, for me at this moment in time, my London session window has still not opened. So I do need to wait for my London session window to open. You can see here 155. So boom, there you go. Straight off the bat, that is my New York Open. So when I'm preparing for New York Open, London Open, sorry. I can already have my order in place. So how would I actually look at positioning this level? Well, 5 minute time frame and the most relevant fair value gap or order block. In this instance, we can see that we have this really nice bearish order block. So I want to just go ahead and literally just place my position on this level and my stop loss above this high. So what we can see here is if I was to use the 30-minute area, right, the level that we're looking at, if I zoom out, this is the order block that we're looking at. If I use this level and target down here, I get, let's say, a 1 to 3. If I use this level and target down here, I get a 1 to 7.2. So that's over double. And not only am I doubling my risk to reward ratio, but I'm also allowing price to show me what it's going to do. Instead of just gambling and hoping that this order block works, I'm actually letting the market prove to me that I am right before I need to risk any of my own money. That is the reality of having an edge. So when London session is gearing up to open, I can already set my order at this level. And London session opens with a tag into my position and an immediate retracement away from my position. And I can even be smarter. I can reduce risk in these moments, right? There's so many little subtle, small details that we can implement that enable us to get much better results than just these standard 1 to 3s. If you can master top-down analysis like the way I'm going to share with you in this video today, you will have the keys to become profitable. Literally all you need is one candle and 3 time frames. What I'm about to share with you is so simple, it hurts my head. In today's video, I'm going to break down step by step the 3 trades that I took following this one candle. Every single one of these trades was taken live with my inner circle students, and I'm going to prove it to you.
And then my take profit level was 1 to 5, and I think I ended up getting taken out at like 4.8.
I also made $25,000 on this day. Let's just jump straight into it. You can see here 3 trades that have been taken. 1 winner, 1 loser, and another winner. And I'm going to break down every single one of those trades, but most importantly, I'm going to break down the top-down approach that I took to take these trades in the first place. And that all starts with this thing right here. So let's go back to before these trades are taken. The key here, and the key to all of this, is this candle right here. This candle is the current daily candle in motion. And when price moves, this candle moves with it. And so my job, right, as a top-down analyst, if you want to be a successful top-down analyst, you just need to understand the character of this one candle. And the way you first do that is basically understanding what the last few of those daily candles has actually produced. So we're going to go to the daily time frame here. I'm actually going to go back before this daily candle has printed. Now, what do you see, right? And yes, it is literally this simple. We have 1, 2, 3, 4 bearish days on euro dollar, right? We have 4 days of bearish price action. Now, the likelihood is that we are going to get a bearish continuation the next day. And the thing that I have in mind here is essentially just a continuation below this previous day's low and a continuation lower. If you look to the left, you just need to identify an area of interest. You don't need to mark out all of these different structure types, go from the daily to the 4 hour to the 1 hour to the 15 minute. No, you just need the daily time frame to give you a read on price. All you need to understand is the probability of the daily candle printing lower or higher. And then you need to build trade ideas based off of that. That's what I'm going to show you. So for me, what I can clearly see here is we have this fair value gap right here, inverted fair value gap, that the daily time frame is now trading into. But we've filled some of that, but we still have more of this fair value gap to be filled. So my bias, even from the beginning of the week, is that we're going to trade and probably fill this fair value gap. So I have an idea of where price will want to react from. I have the context of the last 4 days on Eurodollar have been bearish. All I'm expecting is a bearish continuation, right? It's that simple. From there, once you have that, just drop down to the 15-minute time frame. And so here we are now in the 15-minute time frame, right? And the new day is about to open at 5. So now the new daily candle gets printed. And you can see that here. And what happens is this daily candle prints bearish. And it does give that continuation, right? The daily candle does print bearish, but I'm starting my trading day in London session and finishing my trading day in New York session. So here we have London session has opened, right? This 2 a.m. candle right here, London session has opened. Now notice, this is all the daily bias is. Notice that this is a very aggressive green bullish candle. I personally, if my bias for the day is lower prices, I want to sell when the daily candle is bullish. If my bias for the day is higher prices, or in that session is higher prices, I want to buy when that daily candle is bearish, because I understand also the concept of mean reversions. You see, the higher that price becomes and the higher to the high of day that price becomes, or the closer to the low of day price becomes, the higher probability that price is going to snap back and have a mean reversion. That's what the other 2 trades are based off. But this first trade is based off a daily bearish trend continuation. The 15-minute time frame is bearish and the daily is bearish, and I'm expecting this area of price in here to get filled. I have Asia low and the current low of day. All I need to care about is that this day is going to trade lower than previous day, which it already has, and we are going to revisit the low of the current day, because we're still bearish. Now, I could be wrong and price could continue trading higher, but I would not sure if that were the case. All I need to do is when London session opens up, I need to make sure that the internal range liquidity has been taken. which in this instance it has. And then I need to wait for an order flow shift, which is the 1 minute time frame. So this is daily time frame, 15-minute time frame, 1 minute time frame. Now notice that as price is coming up to this area, as this daily candle is bullish, the 1 minute time frame is bullish. So what we need to see is a reversal. Right now, the daily candle is the daily price and the 1 minute price is moving bullish. I'm waiting to see it move bearish. When it moves bearish, that is when I will look to enter and I will look to sell this market short. So until then, it's just a waiting game. And you can see, I literally live called this ahead of time with my live students. So as we can see, we are bullish on the 1 minute time frame. Eventually, the 1 minute time frame is continuing, which is kind of normal, right? The M1 is bullish. So at this point, I'm not interested in sells. I'm interested in sells when we trade below this level, if we get that trade below that level. And then we do, right? Sellers come into the market, we overpower. This now, for me, is most likely going to be the high of day. So that's what I'm trying to catch essentially as well, is I want to try to catch the high of day. I want to short the high of day. Now, sometimes that can lead to you getting in a little bit early, which is why this is very important. You can't just try to short the market. You need to wait for the lower time frame confirmations. This is why the 1 minute time frame is important. I believe and suspect that this right here is going to be the highest point of this day. And if I just get that correct, maybe I get a break even. Maybe I get a winner. But if I just correct on this being the high of day, I cannot lose money on this trade. So I go now to the 5 minute time frame and I'm just waiting for that's what we have. I'm just waiting for a quick snapback into this bullish 5 minute candle, right? Quick snapback into the bullish 5 minute candle. And then you just want to target the current low of day. So that's 5.21 risk to reward. So if, for example, I'm trading $400,000, which on this day I was, then I am risking $4,000, 1%. But I'm going to gain $20,000 if this trade comes through. And that's what this trade netted me. You can see price tags in immediately, trades away, tags back in, and then literally begins selling off, eventually hitting all of those lows. And myself and countless of my inner circle students took this exact trade. Then comes the New York session. I could be lazy and just say, you know what, that's my day done, $20,000 day, but that's not how this game works. I wanna be the best trader, not just make money. I wanna execute my edge consistently, and I still have an edge to play because now what is in play is still based off the same daily bias. Now that we've had the main move, right, look at this daily candle. Look how aggressively bearish this daily candle is. Remember what I told you just a moment ago. When this daily candle is at the low, the snap back becomes higher probability. So a lot of the times when you have a daily candle, if we go to the daily candle, if we go to the daily time frame right now, and we look at all of these daily candles that we have recently seen, what you'll notice is one thing is common in all of them. You'll notice that at some point in time, right, we have our open, high, low, close. Now, do you notice that, 99% of the time, the low of the daily candle is lower than the close of the daily candle? Very, very important detail. The low is oftentimes lower than the close. So what that tells me, even in a bearish market, what that tells me is at some point in time, we are going to find the low of day, and then we're going to have a bounce from that level. And this candle, maybe it finishes bearish, and maybe tomorrow is more bearish price action, but I know at some point in time, the low of day is going to get placed. And again, I want to catch that low of day. And people oftentimes tell you, don't try to catch the lows, don't try to catch the highs. That's just because they don't know what they're doing. That's just the truth of it. When you understand the daily model, you can do that. And it's okay if you're also sometimes wrong. And this is why confirmation becomes very important. So you can notice, right? Look at all of these daily candles. A lot of the times you have a significant difference between the low and the close, right? Between the low here and the close. Now, this little movement from this low up to the here may not seem like a lot, but if you're an intraday trader like me, that's a 22.4 pip move. If my stop loss is on average, let's say 5-6 pips, well, that's a 3, 4, sometimes 5 times the size of my stop loss. So I can catch a very quick, sharp 1 to 3, 1 to 4, 1 to 5 risk reward on the bounce back. And that's exactly what this idea is about. It's about that in a very bearish day, right? When you're in the market like this, a very bearish day. At some point in time, price is probably going to close up here. And at some point in time, price is going to run this aggressive low. And then eventually sellers are going to get exhausted and price is going to have a bounce. And I want to long this bounce up into the close of that day. That is the higher time frame, daily bias, top-down analysis approach to this system. And it literally really is that simple. And so I come on live session with my members. And now at this moment in time, we are just waiting for a sign of reversal. And for me, the lower price comes down into this level, the better it becomes. Because the more price goes, price has an average daily range move. Although sometimes it breaks that average, absolutely. A lot of the times it has a constraint to the maximum amount of pips that it's usually going to trade. And the more it becomes overextended in that one direction, well, then we're expecting to have a bounce. The lower price comes, the probability starts increasing that bounce is about to arise. And that's literally what we're playing off. And so you can see here, 5-minute time frame, we're just waiting for a bounce. And that first bounce happens here. And this is our first trade taken. In fact, we don't actually get into the market here because this isn't a big enough shift. We get into the market when this high gets taken. So you can see, right, we've been melting off, melting down, and now we're starting to get a little bit of a reversal. And so we wait. Price breaks this high. That's my sign now that maybe this here is the low of the day. Right? That is my bias. The same that I call the high of the day. Now I'm looking at the low of the day. And so again, 5-minute time frame, which is my usual entry time frame. I'm just looking at this inverse fair value gap. So down here, we have this inverse fair value gap, right? I'm putting my longs in here. My stop loss is going below this low. This is quite a larger stop loss than normal, generally speaking. You can notice like this is a 5.7. Usually it's like a 5, 6, 7, 4 pip stop loss. 10.2 is a little bit abnormal, but it's still fine because 1 to 3 risk to reward in this scenario, which is my fixed level, is essentially just a trend retracement. You can see, right, we have essentially a trend continuation, a retracement. Trend continuation, retracement. Trend continuation, retracement. That's all it is. It happens time and time again, day after day. And so again, I'm just waiting for this. And that's the trade that we're waiting for. And eventually price tags us in and then it tags us out, right? Just like this. Then what happens on the lower time frame is notice that the confirmation for me to get into this trade is that this 2-candle 1-minute time frame pullback gets broken. That's my criteria. All of my strategies have mechanical step-by-step rules. They're not random, they're not discretionary, they are rule-based. And I have years of data testing those specific rules to prove that they are actually profitable. So when I make decisions based on what I know works. So what happens here is we run this low. Okay, no problem. Maybe that's not the low of day. Maybe we go for one more sweep, right? That's again, a lot of the times what price likes to do. If we look at the 15-minute time frame, and we also look at how this 15-minute candle closed, it fails to close below this 15-minute candle down here. We fail to break and close below. We create a swing down here. That for me is even a higher sign that we're going to get a reversal. So now on the 1-minute time frame, I'm looking at price and we can see here we have a very small but still valid 1 candle, 2 bullish candles in a pullback that has now been broken and closed above. And what do we have down here? Right, we have number 1, the fair value gap that sits right here. We have the sell to buy region as well that sits right here, right? On the 3-minute time frame, you can see that we have this fair value gap. So we can just literally place our order, entry on here, stop loss below the low. And again, you can see this is a 4.2 pip stop loss. This is a little bit more of an average size stop loss. You can see this is exact trade that we're placing yesterday on live with our members. And then I'm just looking at a simple 1 to 3. I'm not asking for much. It's very easy for price to have just a bounce from here. Even if we then go lower, right? I'm just assuming that this is probably going to be the low of the day. That's all I'm trying to find. And again, many people will tell you, don't try to find the low of the day, or don't try to catch a falling knife, or just trade the trend. I make hundreds of thousands of dollars not taking that advice. So, I mean, please continue. Don't do this, right? More for me. But I literally make a living catching highs and lows. That's what my strategy is. And so, yeah, that is the trade idea. And then you can see price comes back, really nice tag, really nice reversal. And literally we get tagged in around 10 a.m. and we get tagged out at around 10:51. Less than an hour. That's a 1 to 3 risk reward. That's $12,000. I'm risking $4,000 to gain $12,000. And that was my day. 3 trades taken, $25,000 in profit.
All traders
want the same thing. We want to take more winning trades and less losing trades. I've been trading now for over 5 years, and this has been something that I have obsessed over. How can I lose less and win more? And after testing thousands of trades, there's one concept that I use that enables me to take more winning trades and less losing trades. And in this video, I'm going to break down that one simple concept for you. So for us to understand this concept, I'm going to be breaking down the anatomy of a candlestick. Now, before you start thinking, oh, a candlestick, this is super beginner, blah, blah, blah. You hear people online talk about candlesticks, and to be quite frank, they have absolutely no clue what they're talking about. When you really dive deep into the anatomy of a candlestick, it's a completely different game. You see, as a trader, you are trading candlesticks. That is what you are trying to read. Now, a candlestick is just the physical manifestation of the order book inside. And so you may be asking, what's the order book? Well, the order book is this here. This is what the order book looks like. And so on every single time frame, one candle represents the start and finish of that time frame. So if you're on a 15-minute time frame, each candle represents 15 minutes of trading. And in that 15 minutes of trading, the buyers and the sellers, the activity inside of that price leg forms a candle. And that tells you everything that you need to know about what's actually happening in the market right now. And what happens is, inside of this candle is this. And this right here is the order flow. So I'll show you an actual image of an order flow, but for the purpose of this, we're going to simplify it because it's pretty much the same concept. Now, first, let's quickly understand the 4 important points of a candlestick. So this is a bullish candle. We have the high, we have the close, we have the open, and we have the low. The high represents the highest point that price reached in that time period. So if we're on a daily time frame, it's going to be the highest point that price reached in that day. The close of a bullish candle is going to be here. This is where price closed. So at the end of the day, when we go and form the new candle, the close is going to be where we were at that moment in time. The open, which is the low of the body, is going to be where price opened on that day. So when the new day began, we open with a new candle, and that is your open. And then the low is the lowest point that price reached in that day. So we have high, open, low, and close. For a bearish candle, pretty similar, but a little bit different. Because a bullish candle goes from here up to here, that's what makes it bullish. While a bearish candle goes the opposite. It opens here and finishes down here. That's why it is a bearish candle, because price moves lower. So for a bearish candle, you have the high, which is the highest point that price reached in that time period. You have the open. Now, unlike the bullish one that opens lower and closes higher, a bearish one opens higher and closes lower. So the open is here, the close is down here, and the low is down here. Very, very simple stuff. What we want to understand is what's the actual process that's taking place as a candle forms, because the formation of that candle shows to you what's happening inside the order book. And what's happening inside of this order book and what's happening in this candle are one and the same thing, and it's telling you everything you need to know about the current ideology and sentiment from everybody who's participating in this market. Now let's take a look at how we can get the next candle to form and what's going to happen inside of that day. Let's use this candle to be our previous day. So each candle represents one day. This candle was our last day for euro dollar. So we had a bearish day. We opened price up in here. This was the high of price. We had a very aggressively bearish day. We closed down here, and this was the low of price. So how that happens is a lot of the times when you see a bearish candle, this bearish candle may have started bullish. Maybe it started like this, right? The candle opened. We had a run up to the buy side like this. A lot of the times this happens. And then after we've kind of liquidated something or something like that, then we come back down and then we turn into a bearish candle. And then it comes all the way down to here, like this, right? And then it's a bearish candle, and then it comes back up a little bit, and then this is where it's closed. That is how the high to the low and then back to the close is formed. And so understanding this candle is understanding what's going on inside this order flow. So let's say we're going to look at the next day and how that next day is going to form. Well, if this is the close of the previous day, then the next day is going to open here, regardless of whether it's a bullish or bearish day, it's going to open here because the close of the previous candle is the open of the next candle. If it's a bullish day, so, it looks like this, then the open will be down here, right? Because this is where we open regardless. Same as a bullish model, we open down here, and the close would be up here, and that would be a bullish day. Well, let's say it was a bearish day. Let's say, price opens here, we have a run up in price here. So this would be the highest that price reached, and then it comes back down like this, and then trades lower down in here, and ends up closing out as a bearish candle. Maybe price reached down to this price in here, having a bit of a retracement back up during the day, and then it closes there. That would be the open, the high, the low, and the close. That's the formation. Now, how does this get built? What happens during that day? So let's go back to the beginning of the day. So we're starting a new day. And so this is the close of the previous day. And so the new day is going to be opening at this price point. Well, inside of the order book, it's going to be here. The new day is opening at, let's just say, 005. That is the price. So in the order book, we have the price, we have the bid, which is essentially another word for demand, right? Or buyers. And then we have the ask, which is another word for sellers. Just think of it as bid is people willing to bid on something. So you're willing to buy something. And ask, you are asking for something in return. So you're selling something. The current price at any one moment in time is what is deemed as fair value. It's because that price right now is what the market agrees is the fair price for this specific thing at this specific time. It cannot be any other way. If it was to be any other way and the market didn't deem this as a fair value area, then the market would do something about it. So if, for example, this was the price and buyers disagreed heavily with that price, well, what they could do is they could buy at this price. In the order book, there are, let's say, 5 lots of cells willing to be sold at this level. Because at any point in time, there are 2 market participants. You have passive and you have aggressive. Your passive side of the market are the people who put their orders in. So think about your limit orders, right? Or your stop orders. Passive order is essentially a intention to do something. So if you see order book like this and you see, 124 lots of orders up here, what that is that's a person or a group of people who have the intention of selling at that price point. At any point in time, they can remove their orders before they get triggered. The same is true for the buy side. These orders that you see resting in here, they are your passive orders. Then you also have your aggressive orders. Your aggressive orders are the orders that come in at market value from people who aren't willing to wait. So what they will do is they aren't willing to wait for price to come back down to here to buy. They want to buy right now at this price. They don't care. They're going to accept it. That is what's called the premium. So they're going to buy and place that order. Now, let's say there are 5 orders in here, 12 orders in here. And let's say someone comes into the market with 20 lots of buy orders and they're not going to wait. They're just going to buy right here, right now. And so here's what happens. 20 orders come into the market. Now, there is nobody here at this price point willing to sell 20 orders. So what happens? The market goes to the next available block of liquidity, which is the price that has sellers willing to sell what this buyer is asking for. So these 20 lots of buy orders, 5 of them will get filled at this level. So not all 20 will get filled because there's no one on the other side, right? For every buyer, there must be a seller. 5 get filled from here, taking this 5 here from 5 to 0. So now there are no more orders at this level. So what happens? Well, now the current price moves from 1005 to 1006. That is the last active area of transaction. That simply means that this is now the accepted value of price. And so what happens to the candle in this event? Well, it opens here, right, at 1005, where it's supposed to open, and then it trades up to 1006. And so this begins to start looking like a bullish candle. But we're not done yet because there were 20 orders that came into the market at 1005. But there were only 5 available and they were available at 1006. That means there are still 15 outstanding orders. So what happens? Well, price then goes to the next available block of liquidity. And here there are 12 orders. So all of these 12 orders get fulfilled, and the 12 orders that were sitting there go down to 0. And so the fair value of price moves to 1007. And so too does the candle begin to form to the next price point. Now we go into 1007. And so now there were 20 orders, 5 got filled, leaving 15 remaining. Then 12 got filled, that leaves 3 remaining. And so those next 3 orders get triggered at 1008. And so the 33 orders that were in there, 3 of those orders get filled, taking this to 31. And so then they have absorbed the orders. And very likely price is heading back up into this 1008. And so that's how you see price started in here and then traded up until here. And what happens as well in real time, very, very fast, inside of the order book, is that these spots start to fill up very quickly. People come back into the market, and then you'll see a 5 in here. You see a 10 in here. You see a 30 in here. These fill back up, right? You see an 11 in here. You see a 12 in here, right? For example. Now, what happens? Let's say that we get into this price, and this is the exact price that there are now 31 passive sellers who want to get into the market are at. And let's say, let's say there wasn't 30 in here. There were 15, let's say there were 10 buyers in here. Say there were 4 in here. So here we have 15 lots of buys, 10 lots of buys, and 4 lots of buys. So when we reach this level, now we have the passive 31 orders that are sitting at this price point. Well, a portion of them were just filled, if you remember. So now let's say you were a person who had a short position at 1008. Here's how it works. Usually it works in a hierarchical structure, meaning if you were the first person to put your order in at this price point, then just a moment ago, when the 3 orders got filled from this level, you would have been one of them. Let's say you had 2 of your orders. Your 2 would have got filled. But let's say you were the 30th person. Well, you may have an order at 1008, but you didn't get filled because there was no one at that price point willing to take. Remember, these are passive orders. And so as of right now, there is no one willing to buy at this specific price point. So there are still 31 orders at this price point, but no one is taking them. No one is offering the other side. And so that's why sometimes price just stays still. And then you may have an active buyer who comes into the market. And that active buyer may want to take 15 orders. And so 15 buy orders come in at 1008, and then 15 sell orders get activated at 1008, leaving 16 orders remaining. Now we've had transactions, but price hasn't moved. Price has stayed the same. That is fair value. That is the agreed upon acceptable rate at this moment in time. That is fair value. So at any point in time, wherever the market is, that is where it's supposed to be at that given time. Now let's say those 31 orders now drop down to 16, right? Because now the other lot of orders were filled by the person who just came into the market. Well, now let's say an active seller steps into the market. And let's say that seller is a big whale and he wants to initiate 100 lots of that position. Well, now guess what? This candle in here is going to change because those 100 sells that come in at 1008, 15 of them get triggered here, 10 get triggered here, 4 get triggered here, 7 here, 8 here, 5 here, the other 35 in here. And then let's just say there were 150 orders at 1. Well, now what happens? These 100 orders flood to the market, and all of a sudden we go from being here, and then as these 100 orders get filled, 15 get filled here, 10 get filled here, 4 here, 7 here, 8, 5, 35, and then we get into here. And so now we've shifted from a bullish candle to a bearish candle. And this now goes to red. And now we're at this area because these 100 orders that came into the market filled at this specific price point. And then this, where we are right now, is the current fair value. And then let's just say, for math's sake, 30 people come into here and then 100 people come into the market actively, right? It's active people that move the market. They fill those 30, they fill the other 30 in here, and then there's 100 in here, let's just say. As those orders come into the market, price comes back up, right? So we can take this. This is the lowest point that price reached. Price goes from here, 100 come in, 30 get filled here, 30 get filled here. The rest of the orders get filled in here. And then let's say the day closes. Well, that is how the daily candle would be formed. And it's formed off the back of what takes place in the order book. So all of the orders that are being transacted at these prices, that tells you exactly what is in the minds of people. Because now we have the high, the open, the low, and the close. We have a bearish candle. As you look at that bearish candle, you think that there is selling momentum. So sellers may be in control. And that's exactly what is happening. But we've seen it firsthand inside of the actual order book. We have seen that sellers have outweighed buyers today because more sellers came into the market. There were more orders and the buyers could not handle it. They couldn't support it. So they got filled. And we ended up opening here. We started bullish and then sellers took back control of the market and pushed price down. That is what's actually going on in the moment when you see a candlestick get formed. Now that you understand that, you will never look at a candlestick the same again, because now you will understand what's actually going on inside of the candle. Now, in this segment, I just wanted to give you the framework of understanding of the candlestick. I still haven't even gotten to the concept yet, but for me to give you the concept, it's very important that you understand how a candlestick gets formed and what happens inside of that candlestick. Because if you want to be a profitable trader consistently long term, you have to really understand what the market is doing. And the market is the collective of millions of minds who are making decisions. You have to understand what that collective mind is doing, not just what the candlesticks are saying, but what the people are thinking as each candlestick gets printed. That's what's going to make you a profitable trader. Now, let me take you into the concept and how by understanding this and applying one very important thing is what enabled me to win more trades and stop taking trades that resulted in more losses. Now let's imagine the next day was very bullish. We had a bearish day. Then we had another bearish day, but less momentum, less aggression, more of a neutral day. Now, what you can see is that the lows down here, the highs up here, this is more of a neutral. Now, it's more neutral / bearish because we do end up closing lower. The key point you have to understand is that this was the close of the previous day, right? And then this is the close of the day after. So if the close of the day after is lower than the close of the previous day, then it's fair to assume the market agrees that lower than this is fair value, right? That's exactly how it goes. But it's less aggressive. Then let's say the next day we have this aggressively bullish candle like this. So buyers are obviously in control with price. We have a little bit of a wick on the buy side, but pretty strong, aggressive bullish candle. We've broken above and closed above the previous day's high. And then let's say as the next day comes in, sellers begin pushing price down like this. So we open here. It looks to be starting bearish like this. This is the lowest point that price reaches. And then price shifts to go high. And then we get a run of the highs. And so at that moment in time, we've just broken above this old swing high. This is now a bullish candle. So the market is agreeing that price is bullish, that we're supposed to be above this price. But then let's say sellers don't agree with this price. And so they step in. They think that this is a wrong accusation. Then what happens is we start to see a rejection, a move out of this price point and maybe even back to the sell side like this. And then this is where market closes. So we had the open. We had buyers who pushed price up, believing that price was supposed to go higher. Sellers had nothing to say about it. For a moment, there was a time where the market agreed that higher than this previous high was fair. And then sellers completely disagreed with that. And so they pushed price down, outweighed the buyers. And then this is what the candle looks like. And so now what we have is a liquidation. This is a rejection. The fact that price cannot break above this high and close above it being the key word, and the fact that it's also done the same with the previous day's candle, the likelihood of price continuing to trade higher is very slim. So just off the basis of understanding the logic behind price, sellers are controlling this price. We've tried to take out this high. It's been met with rejection from sellers. The market has closed down here. That simply means the auction of the market agrees that price is not supposed to be above this high. So immediately we have a frame for an understanding of price. The problem that many people make is they see this wick here and they believe that this is a break of structure. And so what do? They think that this is indicative of higher prices. They think that that is a bullish sign. So when they come into the market the next day and they see that, they're trying to buy price. And so when they go into a lower time frame, as the next daily candle forms, there's a lot of people out there thinking that this is actually bullish price action. And what makes it worse is the common trait of price here is to open here, give us a move to the upside like this, right? Starting out to be bullish. And then a lot of the times you'll see the continuation. You'll see the real rejection of price. And this usually ends up to be something that looks like this, a very bearish next move. This is what I want to be sharing with you. You have to understand that if a price fails to close above an old high, it is very highly likely that the next candle that gets printed is going to be a bearish one. It's also, a lot of the times when we take it one step further, which we're going to do in just a moment, it also gives contextual understanding to something even deeper, something that you could maybe anticipate. And so what you'll often see in a time like this is, if price was in a scenario where we had a move up to create this pullback to push higher, failure to break this high. A lot of the time, the responsibility of buyers who are propping up these moves is to overpower the sellers that stepped into the market here. There's a power struggle at play between sellers and buyers, as always, supply and demand. Now, when buyers move like this, try to attack this high, fail to break it. The reason they fail to break it is because they push it past momentarily and then sellers step back in and regain control of the market. Many people think that this is a sign of bullishness, when a lot of the times it's actually not. The fact that we closed back inside this range is very indicative that this low down here is now weak and could even be looked to be targeted, because then you'll have a candle like this, and then you're gonna have another day that's aggressively bearish again, and you may see that price starts to prop up. Buyers try to take control of the market. This looks like it's starting to print green, only for the sellers to take back control of the market and push price lower. This is what you will see a lot of times. You'll see that these candles that have these large wicks, they start bullish, and then, or at some point they get bullish, and then they continue moving to the downside. And then when you see a candle close like this one, and you look at it and you see that it's being broken and closed below, that is when you can confirm that this actually is a bearish market. When you have this confirmation, because this is telling you that the market, buyers and sellers, regardless of what they think, because someone can think something or it's supposed to be like this, but the reality is objectivity. The reality is no matter whether people think that price should be higher, the market is agreeing that price should be lower than this old low. So sellers are in control, the market is overall bearish. Now you have a low to a high to a new lower low that is actually confirmed. It's confirmed because we close below it. The difference is that once upon a time price reached above this high, it couldn't hold itself. The market closed below it. The market close is very important because that tells you this is what the market agrees on at the end of this day, at the end of this 15-minute period, at the end of this 1 hour period. This is right. This is fair value. Then you can start building ideas based off of true moves, because once you have a clear break of a low, now you understand direction. And then what you can start to do is then you can really start to get involved in these types of moves, because now you can find something like this, a nice order block like this, a nice supply zone in here, and then you can look at using this level, right, that has a nice fair value gap inside of it. You can use this level to look at building trade ideas, because then even if price makes its way back up, it's likely going to make its way back down because it's the footprint, the flow of orders that make up your structure, right? It's the flow of orders that make up the overall dynamic of price. And so when the flow of orders in consecutive fashion are moving lower like this, the logic is that we move lower. So let's go and apply this now to some real world examples to show some of the mistakes that people make using this, and also how I use it to approach certain conditions that enable me to pick the right trades, pick the right areas, and most importantly, avoid losses and make sure that I'm capitalizing on winning opportunities. So here we are on the 1 hour time frame, right? Euro dollar. You can see that at this moment in time, price is bullish. You can see that price is moving in this direction, right? You can see obviously that price is bullish. Now you can see that the current high is all the way up here. The current low, how we identify that is look at what was broken. So here's the highest point that was broken in this price leg. Okay, now where's the lowest point before that break? So I can just go here to here and pull it across. Okay, the lowest point is here. This is the lowest point. So we go from higher high, right? Like this, from higher high to higher low to higher high. So we're bullish. The trend is overall bullish. Very obvious and confirmed with this break of this high. Then what happens is price comes back in here, looks to go and attack this high. So we have a high up in here that is going under attack. This is the high. As price plays out, you can see we go for the high, but we fail to break it. We actually close back inside of the range. We take the high, but we close down here. So therefore, it's evident that the market has agreed price isn't supposed to be above this high. And yet still people will sit there and try to think that this is a break of structure, and they'll try to buy from somewhere like this, right? An order block in here. They'll put their entries on. They'll put their stops in a safe logical position. They'll try to target the old high like this, not realizing that the likelihood is if market is not accepting this area, then this order block is invalidated. This low down here is probably a target because the responsibility of this low, if the low from here wants to take control of this market, it needs to break this high and close above it with conviction to claim it. And so kind of fast forward to see what plays out. Price trades again. We start coming back to a pullback, and then you can see we have another break of the high without a close. And anyone who was trying to buy from this area just got destroyed. Now, you can see price trade again. We tried to break it, we failed to do so, closed back inside of the range, and then had the aggressive sell-off, and then we closed down here. At this point, it's very obvious that the market is not accepting this low to be in control. It's not accepting that price should be above this high. And so now we have a low down here, which is very likely to be targeted. Now, bearing in mind, this is the mistake that people make. Because for me, we are bullish from the low down here to the highest point price reached up here. That's my structure. So I'm looking to buy, for example, let's say, you have this old breaker block in here, right? You have an old breaker, you can remove this part that's already been mitigated. So you're looking at an area like this. This is a logical area that price could potentially react from, this old breaker level, right? You also have this potential order block that price could react from. These are the areas that I would be expecting for price to trade out from because we're still bullish. But the problem is that people are trying to long from here thinking these are breaks, and they're not. That gets you stuck on the wrong side of the market. And then again, price starts trading higher. And so every man and their dog start flocking to the market thinking that price is going to break higher, when the reality is price has just shown us that it does not accept to be higher than that price point at this moment in time. If it breaks and closes above it, then we can reassess things. But until it does, it's not. And you can see price ends up coming back down and does exactly what? Price ends up breaking below this low, not closing below it, which is key for right now, but we've taken out this low. And so now what happens? Well, so many of people in the market now are seeing the price like we have a high, we have a low, we have a high up here, we have a new low down here. Okay, now I'm going to look for short positions. Maybe they're looking at, the order block in here. Maybe they're looking at the fair value gap in here, right? Even kind of ICT or SMC traders, right? They're looking at positions like this, where they can look at selling. Maybe they put their stop loss at the body closes in here, right? And then they're trying to target maybe the next draw on liquidity or something down here. These are the types of trade ideas that people are getting off the basis of this. When the reality is the market has not accepted this price to be higher. So if you kind of continue playing price out, price begins finding an area of support at this old breaker level, right? We begin rounding off. Now, some traders are trying to get involved in shorts. Some traders have just been tagged into their shorts and they get tagged straight out. Now, we are still not above this high. So until price can prove that we can break from this high, it still doesn't matter. And again, you can see that price begins rejecting from this high. Still a break, nothing. Expecting the next candle to be bearish. It's expected. Same thing again, right? Price cannot break the high. Price is agreeing that price shouldn't be higher. And so now the problem is that everyone, again, same thing, they just got stopped out of their positions above these highs in here. And so now what do they have? They don't have anything. They've just been stopped out once, stopped out twice, right? And they're just on the consistently wrong side of the market. And then price gets the break, and then price gets the close, and that is when we've confirmed that we're ready to go higher. And so now we actually have the break, but most importantly, the close. You can see the difference in the market. Huge difference between price just wicking a high and closing back in versus breaking above and closing with momentum. This clearly tells you that buyers are in control of the market and that market is likely to go higher. Little kind of piece of data that tell you so much once you understand the actual order book. Once you understand what's going on in the order book, it makes reading a price chart so much more powerful. But we still have a problem because there's a lot of the market that's looking at this and they're like, okay, this was a shift of the high, and then there's a little pullback, and then we break. And so they, at this moment in time, they're actually looking at this and thinking, okay, my way works. We had a break, we had a comeback down here, and we shifted higher. So great, it worked. It's a break, we pull back, we go higher. Well, guess what they do now? They use this as their new low. And then they use this as their, high. And so now what they're trying to do is they're going to be trying to long from like this. They're going to be looking at this like, well, I'm in the premium of the price, the discount of the price, like we have an order block here. Price going to come back into here and trade higher. That's their idea. They're going to do something like this. Maybe they put it down here. Maybe they put it on the low. And then they want to go, somewhere up in here. Who knows? But this is somewhat of their idea. But again, they're completely flawed because how I'm seeing this is it's not a high until it's broken. So we have a high, our price goes high, low, up into here, we pull back, we don't break. Because we don't break, this is the high. We failed to break it. So this becomes the high, right? Failed to break it. So now, this is the high. Very, very different concept. We do a low to a high to a low to a high. Very, very different concepts. So this is my low. And then this is the possibly current high if it comes back. If it continues going higher, the high will go higher. But this is what the price looks like. So some people are seeing it like this. This is the mistake they're making because they don't wait for candle closes. They're trying to long thinking this is their protected low. Now, because I know that so many people in the market are doing that, to me, this is liquidity. This is liquidity. So I can expect that price will probably trade through this level. And then you can look at areas like, we have a fair value gap in here. That's the only real level. Kind of have this inverted fair value gap. And so you could build a trade idea off that. You could build a long position. Again, this isn't exactly how I trade. I'm just kind of giving you the frameworks of understanding candlestick concept, because regardless of how you trade, if you can understand how to actually get a bias and what highs and lows to use and how to confirm them, you can trade anything as long as it makes sense. And so you could be more aligned with something like this, where you're taking the open of the fair value gap and you're still targeting the highs. Play price, price begins reversing. Now this is where most of them are trying to get involved in the market. And The market sits in their area. Now they're getting an absorption. So maybe they're thinking that the momentum is slowing down. They get a little run in here. This is probably enticing more people into the market because they believe that this is their low. But for me, it's liquidity, right? That's not the actual low. Then price runs through, gives them another little bit of a reaction, and then eventually takes them straight out, right? And then you get a reaction like that. Like, it's not lucky, it's not right, it's logic. You confirm something when it breaks. It's confirmed when it's broken. The low to the high. That's my structure. The only possible area that could be of interest in this bullish price leg is the fair value gap. There's no fair value gap in here. There's no fair value gap anywhere other than this fair value gap with these order blocks. And you can use the body closes. So it looks perfect. It looks hand selected. It looks amazing. Like, it's just the logic of following the order flow. But you must use the wicks. Again, you can see it here again. We have a low down here. Look at how price doesn't break below that low. It wicks it, comes out, wicks it, comes out, wicks it, comes out, telling us that it doesn't agree that price should be lower than this price leg. It believes that price should be higher than this level. But this is just a pocket of liquidity for price to fish into before we go. And now we're going to look at an actual trade that's aligned with my actual strategy and showcasing the importance of this break. So what you can see right now is we're on the 50-minute time frame. Now, if I just pull us back just a little bit before we get any of these moves, this is the 50-minute time frame. This is how everything is looking. Now, structurally, you know, we were bullish, we had a range, we had another shift, and then we had a change of character. So we had a higher high, lower low, but then we had another higher high. So at this point in time, we shift back to bullish. So at the moment of looking this, in New York session, we are bullish. We have a swing low down here. We have a swing high up in here. We're expecting higher prices. Then we also have, bear in mind, we have NFP on this day. So of course I'm not trading it. This is just pre-context. NFP does this. Now, for those who don't know NFP, what NFP oftentimes does is it fishes liquidity above highs to collect liquidity to be able to operate in the opposing direction. Unless there's a clear intentional macro reason as to why NFP would do a certain thing, it's all the time going to fish for liquidity on one side and then fish for the liquidity on the other side. But notice that we don't get a break above this high. So we wick it aggressively. And a lot of people think that that means that we should be expecting higher prices. How many people had buy stops above this high as it gets rated? How many people, as it gets rated, are trying to buy in that move? Until it's being confirmed, it isn't. And so we have that aggressive low. We close back into the price range, shows us a obvious and clear rejection that the market doesn't agree that price should be above this high at this moment in time. And so what most people do is they use this high and then they use this low and now they have a new high. And maybe they're trying to long from here. Maybe they're not, right? But if they are trying to long, well, they get into their position. They have a great little move higher. Everything's going well. And then they get destroyed. And here's what happens to them. Because now what they do is now they think that they're bearish. And so now they think that they should sell, right? And again, even a broken clock is right twice a day. So it doesn't mean that they're every single time going to be incorrect. It just means that trading is about edge. It's about having a consistent edge over the market. Consistent being the key word. Not occasional. So we break to the highs, they're bullish. They break to the lows, they're bearish. They're expecting lower prices. The price begins trading off to the sell side. But now guess what? They are still bearish on price, right? So we come into the market in London session. So this is the session that I'm trading, London session, 2 a.m. to 5 a.m. EST. This is before the clock changed. They are looking at the market, or a lot of people that make this mistake are looking at the market as bearish. I'm not. I understand that this isn't a break. I understand that the structural level is still like this. So we are bullish to the high. So I'm looking for long positions, but there are more than just candlestick closures in my strategy. So I'll walk you through that. Firstly, if you haven't watched any of my videos, I break my strategy down a lot of times. Pretty simple overall. We look for a directional bias. So what direction is the market going to go using market structure? We're bullish. So I know that in London session, we're bullish right now. I'm expecting to trade higher. That's my expectation. Then I need areas of interest to trade from. So in this scenario, the first thing I do is understand liquidity. I understand that we have buy-side liquidity, which is amazing because that's liquidity for me to trade into. I see a lot of sell-side liquidity across these lows. We have 1 low, 2 lows, 3 lows, 4 lows, on Asia low, on this kind of intermediary New York PM session, lunch session low of the previous day. So what I don't want to do is get trapped, like most of the market, by chasing going long at London Open, because there is a lot of stop losses below this low. And the entire purpose of the market is going to gravitate to collect orders. That is how the market maker makes money. It needs liquidity. It needs to facilitate orders. So I do not want to get trapped. So I need to look at something that is below this low. That's when I can start looking at areas of interest. Now, for me to get an area of interest, I'm looking at a couple of different things. Sometimes it's clean and beautiful, sometimes it isn't. So I'm looking at these ranges in price, right? You kind of have these ranges before you get the aggression. So you have from this low to this high, that is a range, but we have something interesting. We have midnight open. Actually, the clocks went back, so the midnight open is here. We have midnight open, and we also have a very small and picture perfect order block. Now, I'm not a fan for picture perfect. I don't think the market ever operates picture perfect, but in this scenario, it is. We have a picture perfect order block, we have true day open, and we have this range in here. So pretty much I'm looking for a run into these lows, or into these lows, or into these lows, a reaction, and trade long. That's what I'm looking for. Now, I don't get into my positions just by risk entering. I don't like to set my position just like this and then put my stop loss where? Here, 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 here. Doesn't make sense to me. I like confirmation. So what I do is when price gets into my areas of interest, I have a directional bias. I expect price to go in this direction. I have an area of interest. If price gets into this level, then I will take a deeper look at it. When it gets into these levels, I go to a 1 minute time frame. Because remember how we just looked and kind of understood the concept of the order book? Yeah, well, it's the same thing. If I go to the 1 minute time frame, I understand what's really going on right now inside of the order flow. I already have my higher time frame understanding. Now I need to understand the specific details. What I like to see is seller absorption. When price comes into my area, it usually comes in bearish because I like to play continuations. I don't like to trade breakouts, I trade continuations. So when price comes back into my areas, it's usually bearish. So when it gets into my area, I want to see seller absorptions. What is that? You have an area. Price is aggressively bearish coming into your area. But once it gets in there, all of the sellers get absorbed by buyers. You start to see some stagnation, and then you get a reaction. So what it means is sellers try to over-dominate this area, but they can't get past the kind of roadblock, the block that buyers put in this area to protect it. And eventually what they do is they stop taking shots. And when they stop taking shots at this area, now it's easier for anyone who's buying to push price up, because as we look to the order book, there isn't as many orders. And so the market is able to flow higher, easier. That is what I'm looking for. I'm looking for absorption from buyers to sellers, and then a flip from sellers being in control to buyers. And so you can see we're in our area now, and we're starting to get that absorption. If we go back to the 15 minute and we kind of put our area of interest back in this level, kind of this entire region, price is aggressively bearish. It comes in and then we start slowing down because now we're getting seller absorption, right? Aggressively bearish starts slowing down. But slowing down isn't enough for me. I need to see a shift. So you can see here, we run this low. We don't break it, but it's enough to understand that price traded below it. If we can get a run on this high, that for me would be good confirmation that the order flow shifted. Again, you can see seller absorption and then sellers step back into the market. So why would I ever want to be trying to buy if sellers are still in control? It doesn't make sense for me. So I would sit and I would wait. And then you can see we get a reaction from buyers. And this that's occurring right here, this entire thing really is an absorption, right? We're absorbing orders, and then what happens? Aggressive buying momentum. Sellers stop trying to attack this level. And when they stop trying to attack, it allows the buy side to take over. Now it's confirmed. Now the present moment order flow is in control. So I can go to a 5 minute time frame, I can go to a 15 minute time frame, and pretty much I can just identify the area of interest. It's the same thing. I'm looking for, the sell to buy if it's not too large of a stop size. If it is, I'll look to kind of refine it. So how large is our stop size? Stop size is 17.5 pips. Meh. I would rather go for something smaller. You can look at long in from in here. Look at protecting your downside. 11.5 pip stops. It's not too bad. And then what are you looking for? Really and truly, you're just looking for the swing low. All I'm looking for is order flow continuation. We're bullish. I'm expecting another leg. But attention to detail, understanding I don't get trapped by these fake wicks. I don't get trapped by these inducements. And so we can go to a kind of 15-minute time frame, kind of see how it plays out, because what you'll notice is we get an aggressive move, but we haven't breached the high. So this trade is still technically on. We have overlapping fair value gap in this area as well. And so that's pretty much it. You can continue to watch price play out. Now, notice that there was no news, right, in this area. This very sharp, aggressive open in New York session tags straight into the trade. There was no news. It was pretty wild. But such an aggressive move like that, with at least no news, no red folder news or anything like that, but perfectly into this area and then trading out of it again, it's almost too good to be true. I want to say perfect understanding of the market, but I'm not going to make out like I am a genius. I just have an edge, and the edge plays out enough for me to make money. And so we invalidate the fair value gaps, we respect them, we respect the order block, and we continue trading higher until eventually, and it does take some while, because you can see after we do get the reaction, price does start kind of rounding back down into this area. Asia opens a little bit kind of range bound. Now London's beginning to open. We have a manipulation on sell side of Asia, and then aggressive move out of London, and we take out the key level, right? The key old high, the old daily high. The fair value gap is one of the most powerful trading concepts in all of trading, and yet it's also one of the easiest to get wrong. I see so many traders try to master the fair value gap, and yet most of them fail. Starting with part one, what actually is the fair value gap? You see, 99% of traders who try to trade smart money concepts actually fail. And smart money concepts traders are literally being laughed at and actually called dumb money traders. And so the thing that separates the 1% from everybody else who fails is understanding real context. You see, smart money concepts is just institutional level concepts reworded, repackaged for retail. The problem, however, is that retail traders just think that it's pattern recognition. The real traders understand context and narrative. That's what I want to explain to you in this video. So a market is always trying to trade at fair value. What is fair value? Simply put, fair value or efficient pricing is an area of price where lots of trades can be executed. So if we look on the chart right here, you can see that this is the New York session. Here, Friday, the 24th of October, this is the start of New York session on Euro dollar. You notice here that we have a kind of range-bound price delivery before a very aggressive move toward the upside. Well, this range-bound price delivery is what would be considered as efficient or fair value pricing. What we can see is a lot of transactions get traded at this level. How do we know that? Well, we can just simply use the volume profile. So we want to get the volume that was traded from the beginning of this New York session to up until where we are right now, which is 8:45. Now, you'll notice here on the right-hand side, we have the total volume traded at each price level. So you can see the bulk of the volume is traded right here, which congregates to this area in here. So what many people fail to understand is that a lot of the times, most of the liquidity, most of the trading volume is happening in the ranges of price. And then notice we have this huge aggressive move toward the upside when we have CPI data come out. But notice something interesting, that when this move starts taking off to the height of the level, notice that we have this huge gap in volume. Simply put, there was so little volume traded at this level compared to such a small range here, and yet price exploded toward the buy side. And then you can see that volume comes back into the market after this move has occurred, and then we start trading at this level. Now, what is actually going on here? This is real inefficient pricing. So there's two ways to break this down. The first and most important thing that you must understand is that a fair value gap, or commonly known in the institutional world as a market inefficiency, is essentially an area of price where there is extremely low volume, but we still have a movement towards the upside. What that means is that the aggressive buyers at this price point here has controlled price so aggressively toward the buy side, and simply put, there wasn't many passive sellers in this price point. So essentially, very, very few market participants, specifically sellers, at this price leg. Therefore, a very small amount of volume was able to drastically change the current value of this market. Now, a deeper detail for this specific fair value gap is that this was created from CPI. So what actually happens when you have these high impact news events is that market makers are able to legally pull their liquidity from the market. Now, a very brief overview of what a market maker is. A market maker is somebody in the order book who provides liquidity on both the buy and sell side, pretty much at most price levels, so that other traders can get filled on their transactions. And then this market maker is rewarded by taking the spread. That's how market makers make money. Now, a market maker, for example, is a Citadel. Citadel actually makes most markets. It actually has a very high total volume of the overall market making. It's one of its largest kind of arms of its business. So those market makers are able to come out of the market at that price point and remove their liquidity from the order book. When that liquidity gets removed from the order book, it makes it very easy for a small amount of aggressive buyers at that time to push price higher and very fast because there is so few passive sellers at that price point. And that's the way an order book works. Now, what happens after that fact is that there is this gap, right? And from a technical standpoint and how most people view a fair value gap or an inefficiency is with a 3-candle formation. So what you wanna see is an aggressive candle is usually the first one and a kind of explosive candle, but it's a 3-candle formation. So we have candle number 1 in here, and then we have candle number 2 up here, right? And then we have candle number 3, which is here. So if I remove this gap for a second, those are our 3 candles. Now what you will do is you will take, in a bullish example, the high of candle 1 and the low of candle 3. Notice that they do not touch. This 3rd candle in here and this 1st candle in here do not meet. That is essentially the potential for inefficient pricing, or what you could call a fair value gap. So you would simply mark the 1st candle high and the 3rd candle low, and that area right there would be your fair value gap. And to confirm that level, simply just understand the total volume that was traded at this level. And you will see that there is a huge gap, essentially, in the overall volume. That gap is inefficient pricing. Now the theory is that price will want to trade back into this price leg at some point to essentially offer price or re-offer price at this price leg. Because again, price has skipped a beat. So imagine if you are a buyer or a seller in the market and you actually wanted to buy or sell at this level, you just wasn't actually available at that time. Or maybe your orders actually didn't get triggered because there were so few other orders in the order book. Let's say you were a passive buyer, but there was no sell-side liquidity. So essentially what happens a lot of the time is there's a lot of traders that were not filled at these prices that may have wanted to get filled at those prices. So a lot of the times price will re-gravitate back toward this level, and a lot of the times close at least half or sometimes even the whole gap of price, which is essentially price just re-offering at that price, seen as though many traders were not able to transact at that level. There were so few trades transacted at that level. The market wants to re-offer price at that level. Very, very simple. So that's why a lot of the times you'll see these gaps, right? And you want to validate them with understanding what the actual volume at that price level is. That is a fair value gap. Now into part 2, I'm going to reveal to you how to actually understand when to trade fair value gaps and what fair value gaps to trade. As we look at the market here, I'll be honest, we can see that there are literally hundreds of fair value gaps that occur on any kind of one given daily basis, depending on what time frame you're looking at. Now, why is it then that so few of them actually hold? I mean, if we just literally look at this market right now, you will see so many fair value gaps and you'll see some hold and some not hold. The thing is there are distinct tells of whether a fair value gap is really a fair value gap that price will hold. And that's what I want to break down to you right now. So essentially, we just spoke about this fair value gap that was created from CPI on Friday, the 24th of October, right? Which is a couple of days ago as of recording this. Now notice that we have this fair value gap, and actually me and my live trading members, some of us took these trades from here, literally just trading back into this fair value gap because we knew that the likelihood is that gap is going to get filled. Now, notice when I come into the market today, right, Monday, the 27th of October, this is how the session looks. This is how price actually looks, right? We have yesterday, we have the Friday's price leg. We come into the end of Friday, we have this range. Notice as well, right, that this range here makes up the majority of the total volume, right? So don't be confused. Ranges don't equal low volume and big moves equal high volume. That's not necessarily true. So we have this right here. Now there's a couple telltale signs of how I was able to catch this trade this morning that still hasn't fully completed, but I'll break it down anyway. So we want to identify the best fair value gap to trade. Now notice here that we had this fair value gap, and notice that the majority of that fair value gap has been filled. Now most traders, if they didn't have the volume profile, would actually think that this fair value gap is essentially just now finished, right? It's useless. But if you look carefully, you'll see that this candle right here, the first candle that initiated this move, still hasn't been traded into yet. And so from the lowest point that we come, which is literally right here, you can see that there's still actually a fair value gap here. And if you slide this fair value gap across, notice what we have on the overall volume. We have a very low volume area, which is essentially a market inefficiency. And so if we just look at this overall area, we mark out a fair value gap, and we have this inefficiency. This is the first sign of a good fair value gap, right? The second sign of a good fair value gap is the overall trend of price. This is the most important and honestly most simple. If we look at the directional kind of bias of this market, we are very clearly bullish, right? We were in this downtrend, we were putting in lower lows, lower highs, lower lows, lower highs, lower lows. And then eventually, this is my kind of swing high. We take out this high and we become bullish, right? So we're actually bullish coming into today. That's the most important thing. You have to understand what's the likelihood of price trading higher or lower in this one session. And the key telltale sign of what that is going to be your market structure. So the second key, after identifying the actual validated fair value gap from the volume inefficiency, is the overall trend of price. You have to trade in alignment with the overall direction of price. Point blank, period. It's a complete non-negotiable. You will be surprised at how many people try to short when the market is bullish. And it's very evident. Like if you look at the fair value gaps that come to the left when we're trending bullish, right? You can see in here, we have all of these bearish fair value gaps that are getting formed at these price points, and eventually all of them get traded through. Because fair value gaps are great, but they have to be traded in alignment with understanding the overall context of price. So when I'm coming into the market today, the first thing, honestly, that I'm looking for is low to high, bullish. Okay, second thing, point of interest, which is my fair value gap in here, which I've just explained to you. Now, another thing, and a very important thing, is liquidity, right? So notice here that on these lows, we have equal lows down here. We have an old low down here. Now, these equal lows, this old low here, represents to me liquidity. We have Asia low as well. So for me, all the time, I need to see a liquidation of price. What I like to see is I like to see liquidity get built at a certain price leg and then sweep that liquidity into my point of interest. So I like to see price sweep into a point of interest. That's the third thing. And the second part of the third thing is liquidity to target, right? Liquidity to take, liquidity to target. You've heard me say it before. Liquidity to take down here on the sell side. Liquidity to target is the high of the previous week. It's the high of the previous day. It's the high of the Friday session. It's the high of New York session. And we have Asia high here, creating a relative equal high across here. So this is a very, very obvious point that price will want to revisit. And so this trade setup becomes literally super simple to me. Now, if I didn't have these, right, if I just had a fair value gap or just a fair value gap, I wouldn't know which way to go, right? There's fair value gaps in here. Should I trade those? Should I trade these fair value gaps? What about these ones? right? Just understanding fair value gap and seeing them in the market isn't enough. You have to have context. And so for me, the context is the direction of price, right? Bullish is the low volume in here, the context of what this move represents, the liquidity that we're going to take out on the way, and the liquidity that we're going to target. So trend, verification of a fair value gap, plus the top level in here, that makes an actual good fair value gap.
To make money consistently in trading, you need a trading strategy that is repeatable, systematic, so it's rule-based, and very simple to understand and easy to use. In this video today, I'm going to break down with you my trading strategy, and this is a strategy that I've used for the past 4 years. I have all of the data for the strategy that I'm going to share with you in just a moment. It's also the trading strategy that hundreds of my students have used to go on and take crazy amounts of payouts. So what you're seeing on screen now is the trade that we're going to be breaking down at the end of this video. It's the trade that I took, it's the trade that many of my inner circle students took. On the right hand side, you'll see 5-step SMC strategy, and you'll see the 5 rules of my system. I'm going to be breaking down each of these rules, and then at the end, we're going to take all of our rules and follow them step by step till we have a trading strategy that is working. Now, just before we dive into my 5 rules for this strategy, I need to tell you something that I wish someone had told me 6 years ago when I started trading. A trading strategy alone will not make you money. There are more important things in trading strategy, because the reality is there are millions of traders that have a strategy that works but still aren't able to make money from trading. In fact, the reality is you've probably seen trading strategies that already work, but you still don't make money from trading. And that's because there are more important things in strategy that I want to break down for you. So again, I'll leave the link in the description. It's free, enjoy. And now I'm going to show you the data to prove that. So here I am in my TradeZella, and I want to share with you my playbooks. This is the strategy I'm going to be showing with you today. It's the intraday bias model, right? It's my best performing strategy. You can see here I've taken 230 trades. This starts at the beginning of 2023. So from 2023 up to today, 2025, 230 trades, 216% return, right? So we're averaging over, I believe it's like over 10% a month with this model, traded perfectly. You can see here all of the data on the model. If I go into here, you can see these are the stats of the trade, right? You can see from the beginning of 2023, very healthy equity curve. You can see day win rate, you can see trades taken, win rate of the system. A huge misconception is I have a 33% win rate. People think that that's a bad thing. People just don't understand trading. Win rate alone is useless. You need win rate plus average risk to reward. You can see here I have a 6.23 average win to loss ratio, meaning for every 1 trade I lose, on average, I win 6.23, right? So if I risk $1,000, then on average, I will make 6.23 times my loss, right? Which is my risk, which is $1,000. Yeah, this is all the data. Really don't need to go into too much detail about it. It's years and years of data with one model. And now we're gonna show you exactly what that model is. So let's dive in. So my first rule is directional bias. And essentially what directional bias means, my primary objective when I come into the market is I need to understand which direction is the market gonna trade in. And then I need to trade with that direction. It's very simple. Markets trend and you want to trade with that trend. It's the oldest saying in the book, right? The trend is your friend. But the reality is you will make the most money when you trade with the direction the market is heading towards. But you need a way to understand what that direction is. So step 1, simple directional bias. Very, very simple to understand, to be totally honest with you. The market moves in phases, right? We have bullish phases, right? So we have these kind of expansion phases. We have consolidation phases, right? And then we have bearish expansion phases. All you need to do is understand the external swing points of structure and use those as your directional anchor. It simply means just find the areas of price where we see reversals. So you can see here, price puts in a high, and then we reverse from this high. We put in this low, we reverse from this low, we put in a new high, we reverse from this high, we put in a new low, we reverse from this low, we put in a new high. All of the reversal points, it's that simple. And that is what makes up your market structure. And it's a very simple thing, that if your swing points are getting progressively higher, then the market is bullish and you want to look for longs. It's really that simple. When you get this high, at this point, you want to wait for price to start coming back and you want to identify this area here and you want to buy from that level. And I'm going to show you exactly how you do that. But that is literally how simple it is. Again, it needs to be stupidly simple. So many traders are overcomplicating trading today. And that's the reason that so many traders are failing, because they think it should be complicated. something that I struggled with. When I simplified my trading, I became so much more profitable, so much faster. Eventually, what happens is after we've had a period of, aggressive expansion, right, or contraction, at some point in time, you'll kind of meet an area of consolidation. That's where price goes into this little bit of a choppy range where it's kind of undecided. Maybe you spend a couple of days between, let's say we have a low down here and a high up here, right? And then price is just kind of spending its time not breaking out of the highs, but also not breaking out of the lows, right? This is an area where there's a lot of fair value created. When you see price trading at the same level and not really breaking out of a high or breaking out of a low, what it means is that buyers and sellers are pretty much in agreement that price should be at this level at this given time. And so a lot of volume gets traded at these areas because, again, both parties are mutually agreeing that this is a fair value for price. These are the areas that, again, they're uncertain areas. These are the areas you really want to be avoiding, at least for me in this strategy. I don't want to trade in these consolidative areas unless I can identify the swing areas. Usually what you see is after some type of range, right, we'll maybe get a continuation, which is possible. You may also get a reversal. A reversal is essentially we had a low here that put in this high, which is higher. So what happens is every time that we put in a new high, right, we go low, high, we pull back, we go higher, high. So when we break this old high, right, that becomes a break of structure. Now what happens is this low that broke that high and the high that gets created, that's now your range. And then price comes back, puts in a new higher low. And then when it breaks above that high, that again is a break of structure. And so that becomes your new range. Now you have this low here to this high. And you're expecting that price is probably going to come back down a little bit and then trade above this high. Plain and simple. Now, what ends up happening a lot of the times, at some point in time, you will have a reversal, which I refer to as a change of character, right? Think of character as a bull and a bear, two characters of the market. The bull represents increase in price, higher prices. The bear represents decrease in prices, lower prices. When you have a change of character, that's essentially saying that the bull was in control, price was increasing, and then the character shifts, and now the bear is in control, price is decreasing. Very, very simple stuff. So we have a change of character, and that happens when the low that put in the most recent high is broken and traded through. And so instead of having a higher low and a higher high, we actually end up getting a lower low. So this low right here is lower than the previous low. That is a change of character. At that point, price has likely shifted bearish. And so what do you think you're looking for? You're looking for sells, right? It's really that simple. You're just looking to sell the market. At that point, you go lower low, probably lower high, and then lower low, right? Break of structure, lower low, lower high, lower low, break of structure. And now you're in a trend. And now this is your swing high. So you want to sell as long as price stays below that low. This is your swing low. When you sell, you want to trade into that low. You only trade on the pullback. So when price starts coming back up here, you patiently wait for your time to enter, which I'm going to tell you what that is in step 5. And then when that signal occurs, you try to trade short and you trade short toward this low. That is literally the strategy. There's a few minor details and things that I need to explain that makes it better to understand. But in short, that's a strategy. I mean, we're selling a bearish market and we're buying a bullish market with a very simple reversal model. So that's step 1. Now, the reality is that the market doesn't always look that clean, right? A lot of the times you'll have price action like this because it's easy for someone to say, yeah, just buy the bullish trend. The problem that 99% of traders have is they don't really know how to identify the trend. They're looking for these swing points, but most of the time they're choosing the wrong ones. And the reason for that is because the market isn't as simple as the diagram that I just showed you. In fact, the market a lot of the times looks more like this. And for some reason, for most people, this is oftentimes confusing, but I'm going to simplify it for you right now. You can see here, we start with the low, right? Price trades higher, and then we put in a high. So at that point, we have our set points. We have a low down here, and we have a high up in here, right? Let's already assume that we are bullish, right? So let's just assume that this was the price action. We broke structure toward the buy side, so we were bullish. So now what we have is we have the low that's in control is here. The high that's in control is here, and we're bullish. The directional bias is bullish. That's what we're looking for. Now, what happens to a lot of traders is, for one reason or another, is they start using this in here, this structure. And what they see is they see that these structure prices, and I'm going to show you this in the actual live market in a moment, but for some reason they see these structural levels, price puts in a low, puts in a high here. Oh, okay, now we have a lower low. And they look at this and they try to trade this internal structure. And so they're trying to sell here, but when in reality, price is still bullish. And so people get confused with these structure points. And you need to understand which one is which. And so my framework of thinking is very simple. You have a swing low, you have a swing high. As long as price is inside of this box, it's internal structure. So when price breaks these structure points, we don't try to short. We're waiting for confirmation to go long. Eventually, at some point in time, price breaks above this high, right? That's a break of structure. Now, with the same box that you had to understand what the internal structure was, when we break that high, and then that high begins to produce a reversal like this, now we need to identify our swing low. And all we have to do is go into the box and find the lowest point before the expansion, and that's our swing point. And so that right there becomes our swing low. And so now we have a new structural leg. We have swing low down here, and we have swing high up here. And the same thing is true. We are just expecting higher prices. But the problem is again, for some reason is, okay, sure, maybe you're not the type of trader that trades this structure, right? Because it's simple to you. You see bullish, it's still bullish. Maybe you're the type of trader then that in this expansion phase like this, when price comes below this low, you now think that we've shifted bearish, right? A lot of traders do this as well. They think that this is a change of character. And what happens, unfortunately, is when they see this as a change of character, they try to start, shorting the market. And they try to start shorting the market, highs in here or highs in here, and trying to trade lower. But the truth is price is bullish, right? So you're on the wrong side of the market. And I think personally, the number one mistake that traders make is not understanding which direction the market's going to trade into. If you can understand that, you're good. And so this isn't a change of character. It's just a liquidation. Why? Because the swing low is down here. Here's the low. So if this low gets taken out, we're still bullish because we're bullish until this low gets broken. So that's the reason that, most people don't understand directional bias, is because they get stuck in these internal levels. And I'll show you this right now in the actual market. So you can see that we're bullish, right? At this point in time, you're expecting higher prices. Now what happens is we end up shifting these lows. And so we become bearish, which is no big deal. That happens a lot of the time. After a long bullish run, we become bearish. We have a change of character. So now we are looking for shorts. It's very simple. Our swing high is here and our swing low is here, right? Both of the reversal points. This is the high, price reversed. It met this low, price reversed. So we're bearish. So that's our swing high in here. This is our swing low. We are just expecting price to take out this low as long as it remains below this high. It's that simple. We play price. You will see that now we have broken below that low. And so again, remember the box method, right? If we have from this high in here to this low down here, and we just draw it across, everything inside of this box was internal until we broke the low. We have to find the highest point before price breaks this low, which is where? Which is right here. Right? The high of this Asia session. So now we have the swing high that breaks the swing low. So that's a break of structure. And now we're starting to see this low produce a reversal. Now it's definitely a reversal. So this is our swing low down here. Again, what are we expecting? This is our high. This is our low. We're just expecting price to trade toward this low and remain below that high. That's our bias, right? We can see here is that price reaches this high, fails to break above that high. Again, fails to break above that high again, and then has the aggressive sell-off. And then we break this low, break of structure. So now what we have is new structure, right? We have our swing here. Because we create equal highs, it's basically the same area of structure. So now what we have is we have a new swing range. We have the low down here, and we have obviously the high up here. So it's the same thing again. We've had the reversal. We're just expecting that price will revisit these lows. And that's our read on structure. And all of this time, I'm just trying to short the market, providing that the other steps of the system align, which we'll get into. So again, we can see that this was our swing high. We had our swing low down here. What happens? Price comes back up to here before eventually selling off and what? Taking out the low. So then what happens? Price begins to reverse. So now we have what? New swing structure. All right, we have a swing high because it's the highest point before the break. And then we have our swing low. High, low, price comes back up. We start trading back down. Now this for me is not a break because it is just a wick. It has to break below that low. Then it breaks below the low. So now our new swing high becomes here. And again, all we're trying to do in this market is just sell at certain areas with certain confirmation. So we have a high,
we break down to the low, so that's our swing high. What happens? Price starts to pull back, so now we found our new low. That low gets broken here. Where's the highest point? Price comes high, starts trading through, comes back up, goes higher, and then trades and breaks the low. So, and then it gives a reversal. So we have, this is our low, and this is our high. Price puts in a high, in here, ranges around, and then it breaks the low. Then you come in, and guess what? Now you have your swing high, which is up here, and your swing low. And then guess what? We're just looking for shorts. When I see my confirmation, which I'm going to share with you later, this is the type of trade that you get. And bear in mind, this is one trade. There has been many of these types of trades in all of this price action, once you just understand exactly what the rest of the steps are. So that is directional bias, right? Very clear to see that we just trade in alignment with this trend. We don't need to try and trade against it because the trend is obviously in control. So moving on to rule number 2, we've done directional bias. Rule number 2 is time and price. You see, there are specific time windows that I execute my strategy in. Those time windows are as follows. For London, we can trade from 2 a.m. to 5 a.m. That's Eastern Standard Time. We can only trade inside of that window. If there is a trade that sets itself up at 1:58, I cannot take that trade. If there is a trade that sets itself up at 5:05 a.m., I cannot take that trade. Just inside of that window, I can take that trade. The second window that we have is 7 to 10 a.m. Eastern Standard Time, so New York time. So I have 3 hours in London from 2 to 5 a.m. and I have 3 hours in New York from 7 to 10 a.m. Now here's the truth. This strategy has relatively equal results across each time window. Some people could only trade London, some people could only trade New York. It's completely okay if you just have 3 hours a day to trade. You can still take this and still get the same results because the results are split across both of these sessions. I personally like to trade both of them for the most part. So 2 to 5 a.m. for London session and 7 to 10 a.m. for New York session. Now we move into step 3, right, which is my third rule. Now my third rule states that in order for me to take a trade, I must see a liquidation first. What does that actually mean? What a liquidation is a key area of price gets taken out before my trade enters. So if we look at this trade here that I'm going to be breaking down at the end, notice in this blue box right here is Asia session, right? In the green box is my London window, you can see 2 to 5, and my New York is 7 to 10. So this blue box here is Asia session. So if I want to trade in London session, for example, like I do, this short here comes in London session. For me to trade this setup, right, bearish, I first need to see Asia session get taken out. So for example, if we're bearish like this, and then let's say, you know, we have this range here is Asia. And then let's say London session opens up and I get all of my confirmation, but we don't take out that Asia session high, I cannot trade. So this right here is going to represent our Asia. And then London opens and it gives me everything else I want to see. But we don't trade above this high first, I cannot take that trade. Because in order for me to take that trade, I need to see a liquidation. And a liquidation in this model is the Asia high. So here I need to see this Asia session high here be taken out before I look for a trade. And if we are bullish, for example, right, let's say the market was bullish, the same thing is true. If price is bullish, like so, and the Asia session is in here, if London opens, it gives me everything I need to see. I still cannot trade that because Asia session high remains not taken out. So if we have Asia like that, for example, and then London session, you know, is expansive, like so, I still can't take that trade. I would need to see this happen, right? And then I could take that trade. So step 3 is liquidation. I need to see a liquidation. And for my London model, it's typically Asia or Frankfurt. Now, rule number 4 is reversal confirmation. So what a reversal confirmation is we may be bearish, like for example, you know, before we take this trade, right? Let's go before this trade is entered. This is what the market looks like. We are obviously bearish. However, we don't know that price is going to take out this low right now. So if we just start selling all the time, we could end up taking 5, 6, 7, 8, 9 trades, and they could all just trade straight through us, because for all we know, price could come all the way up here, right, before it trades back down here. And also, another truth is, we don't know for sure that price is going to take out this low. We just know that that's the highest probability. There's more than a 50% chance that it will take out that low based on historical data. So for all we know, we could trade through this level. So what we need to see is confirmation that price is going to reverse. And then that reversal will indicate a higher probability that yes, now it is time to trade toward this low. And for that, my reversal confirmation is a very, very simple thing. You see, I use the 15-minute time frame for my strategy, the higher time frame. My lower time frame is 1 minute. So if I, for example, am bearish like this, now when the market coming back up like this, right, we hit this low, we start trading higher, guess what's going to happen? If we go to the 1 minute time frame and we look at this, the 1 minute is going to be bullish. You can already see it. The 1 minute, right, is bullish. Putting in these higher highs, right, all the way up until, you know, we come into London session. You can see that the 1 minute is bullish. And the current structural landscape of the 1 minute, we have a swing low down here and we have a swing high up here. We break structure, so we're bullish. So if the 1 minute time frame is bullish, but the 15-minute is bearish, we do not look to trade yet. What we need to see is this low get taken out. We need to see the 1 minute also shift bearish with the 15-minute. And so then we have something that looks a little bit like this, right? Let's say you have the main time frame, you know, your 15-minute time frame is like this. And then as price starts to come back up, your 1 minute time frame is bullish. You don't know when price is going to reverse. If you just see, you sell short here, and then price trades higher. You might sell short again, price trades higher, right? You could take multiple losses in a row. And like I said, for all we know, we might end up seeing price shift back to bullish. And so all of a sudden, you might have just taken 6, 7, 8, 9, 10 losses because you couldn't wait for the confirmation. And that's what we see so much. We see traders that don't know how to confirm their trades, and so they keep taking loads of losses on a trade. So you simply wait. As price pulls back up, the 1 minute is bullish. At some point, the 1 minute will shift bearish. When that 1 minute shifts bearish, now you can trade. And you simply just trade off the back of that 1 minute reversal, and you take it down to the swing low down here, right? That is how we could get a higher win rate and a higher risk reward. That's why our average win to loss ratio is 6.23, because we use this lower time frame. We're scaling down to get a more accurate kind of sniper entry, if you'd like. And so that is our lower time frame confirmation. So let's say, for example, we break below this low like that. Well, now the 1 minute is no longer bullish. The 1 minute is bearish. We have our liquidation of Asia session high. Now we're good to trade. And now rule 5 is order block, fair value gap, or inverted fair value gap entry model. So what I do is after we get this 1 minute shift like this, I usually go to a 5 minute time frame. On this 5 minute time frame, I'm looking for an order block, a fair value gap, or an inverted fair value gap that I can trade from. Ideally, if I can get a multitude of them combined together, that's going to be the area that I take. So if we look at price right here, what we will see is first and foremost, we have a bullish fair value gap here that gets inverted, right? Traded through. So that becomes an inverted fair value gap. At the same time, we also have a 5 minute fair value gap here. We also have another 5 minute fair value gap here, right? And then we also have, you know, this M5 order block, right? You could use this buy to sell. You could use this as your order block, this final buy to sell, right? So here you can see on the 5 minute time frame, we have an inverted fair value gap, an order block, and a normal fair value gap. Sometimes you might just get one of them, sometimes you might get a couple of them, sometimes you might get all of them. But I'm looking for the area of price where we get that confirmation. And then I'm just going to choose one of those areas and take my trade. And so for example, short position in here, my stop loss would go above the high. Then where would I look at targeting? I'm just trading in direction of the trend, right? The 15 minute is bearish. I'm expecting the probability indicates that we will get lower prices. So if that's what probability indicates, then I'll just take my trade down to this low in here. And again, we can just use this inverted fair value gap, put our stops above the highs. And you can see here, 1 to 5.57 risk reward. And then if you risk $1,000 on this trade, you return $5,570. So that's why you can have a 33% win rate, take 10 trades. Let's say you just win 3 of those trades. But if my average is 6.27, let's just say 6, If I take 3 trades at 6, what do I return? 18. If I lose the other 7, then I lose 7. However, at the end of those 10 trades, I've won 18 times my risk and I've lost 7 times my risk. So if my risk is $1,000 per trade, I've lost 7 trades, so I lost $7,000. I won 3 trades, but I made $18,000. The net profit is $11,000. That's how the risk reward and win rate game goes together. And so that would literally be the trade that's taken. Of course, I said, at the end, I'll show you the trading strategy. I've kind of already walked you through everything. And what I will say is this is just one model, right? So this playbook, the playbook that we kind of went through here, which you can kind of see, this playbook actually does have multiple variations of it. One of those variations is this right here, which is my London sweep Frankfurt reversal model. I also have 6 other models, these same criteria, but again, those 6 other models, those are kind of, not really something, to be honest with you, I'm willing to share on YouTube. But this one in of itself is more than good enough. It's profitable enough. Go and test it for yourself. And that pretty much becomes it, right? That becomes our strategy. We have a 15-minute time frame that is bearish. So we're looking for shorts. Is it between 2 and 5 a.m.? There's 2. At the moment that we're going to take the trade, it's 3:30 a.m. Great. Step 1, step 2. Bearish in our time window. Third rule, do we have the liquidation? Yeah, we liquidate Frankfurt, we liquidate Asia. Great. Step 4, lower time frame confirmation. Has the 1-minute time frame shifted to align itself with the 50-minute time frame? Yes, it happens right here. Okay, great. There's 5. There's 4, sorry. And then step 5, do we have an order block, a fair value gap, or an inverted fair value gap on the 5-minute time frame to take the trade? Yes, we do. Those are all the rules that come together for this one specific model. And that would mean you have the green light to execute on this trade. Now, again, look, we'll kind of see how the trade plays out on managers, but there's something super important is you can have a trading strategy. So many traders have trading strategies that work and they still don't make money because trading strategy is only 33% of the equation. There are 2 other things just as important, maybe even more important than trading strategy if you want to consistently make money. Let's see how this trade plays out. All right, you can see price tags us in. It's hovering around price for a little bit. This is where psychology becomes important. Many traders are deviating from their plan. At this point, you can see, for me, it's just a game of following my rules. I also have rules in place for when I move my stop loss to break even, etc., etc. But you can see, there's the shift, price tags in, we move, we pull back, we move, we pull back. Like even on the 5-minute time frame, you can see the structure that we use. You can see the directional bias, and that becomes our end target.